All right, we should get started. So this session's on agent-based modeling, which is one of the main methods that people use in complex systems. William asked the moderators to give a kind of overview of the field and some key issues to sort of help glue things together. So I'm going to give a quick overview, and then we'll go on. We're having a total of 6 presentations in the session. So just to repeat a theme from this morning, there are really 2 competing theories about how you should go about modeling human behavior. One is through constrained rationality, that is, agents that have rational expectations but have frictions that constrain them, and versus bounded rationality, where you have heuristics and myopic reasoning and you try and more realistically model how people actually make decisions. I want to first say that, constrained rationality, you really have to use an as-if argument, because nobody believes that individuals are really that smart. Somehow they have to collectively act as if they were that smart. Whereas bounded rationality, I would say, has what I would call verisimilitude. That is, we all stumble along in our lives making decisions as best we can, and that's the literal method that's used. One of the big ramifications, though, these require completely different methodologies to back them up. If you want to solve a DSG model, and I think most of you probably know roughly how that works, you define the economic context, you write down utility functions, you derive some first-order conditions, you solve some equations, and then you find a fixed point. If you want to, let me just say that leads to a kind of old-fashioned style of doing things, and that you spend most of your computer time on finding that fixed point, and you can't really take advantage of new technologies like big data and large-scale computing very well, because that's not how you set up your model. In contrast, complex systems embraces bounded rationality, and so you can simulate things in the style of a dynamical system. And a simulation, I'm going to say a little bit about this because I worry people may not quite understand what the difference is between solving first-order conditions and fixed points and simulation. In a simulation, agent-based modeling just refers to the fact that you're simulating the behavior of the decision makers. You give those decision makers rules for making their decisions. The rules might involve learning. They can have different degrees of complexity, but there's, at the end of the day, they're rules. And then you make a simulation. That is, you take the real world and you try and build an analog of it inside a computer. And you automatically get a dynamical system. That is, each agent makes his or her decision. You use the computer to determine the economic consequences of those decisions. And then you go around the loop. Then you have the agents make decisions again, see what the consequences are, and you just run that loop indefinitely. The simulation of bounded rationality makes this feasible. If you're trying to constrain rationality, it's typically not feasible. Now, one of the great things about an economic simulation is each household and firm can be different, so you're really not restricted by heterogeneity. Heterogeneity is not a problem, at least in terms of running the model. It may be a problem in terms of calibrating the model to understand what reasonable ways to make the different agents different are. You can do nonlinearities, you can do complex interactions, you can couple all the pieces of the system together. None of those things produce problems. What are problems are coming up with the right way for the agents to make decisions, having the granular data that you want to have in order to calibrate your model at the micro level, understanding the model results when they're done. The model might do something complicated, and it can be hard to understand what cause-effect relationships within the model actually drive the results. There's also a big challenge in creating software for simulation. That can take a lot of time, and challenges in making large-scale simulations run quickly. Now, the great advantage of going through this is that you can actually understand emergent behavior. So you can start with individual components, and you can simulate their interactions with each other, and you can understand how things happen collectively that would not happen at the individual level. when you have nonlinear behavior in a system, the whole is not equal to the sum of the parts, and you can see things emerging as a result of that, like endogenous dynamics. In other words, you can get oscillations out of a system where it's not at all obvious why those oscillations should be there to begin with, and they happen endogenously. Now, sometimes you see these systems settling down to equilibrium, and sometimes you don't. And some work with my collaborators, Marco Pangalo, Tobias Gala, Torsten Heinrich, and James Sanders, we've looked at, for example, how this works in normal form games. So we take heuristic models for decision making, we simulate interacting game players. Why do we use that? Because it's simple and because we can exhaustively enumerate the universe of all possibilities. So study not just one game, but all possible games. And we basically find that equilibrium becomes unlikely when the games are complicated and competitive. So in the converse of that, we do see things converging to equilibrium. But as soon as things get complicated and competitive, we don't find equilibrium anymore. And what we see are endogenous chaotic dynamics. That typically happens when you get more than two players and when you have many possible actions. Now, I just want to reiterate the point I made earlier that complexity economics is a young field. We have a lot of challenging things we have to solve because we haven't had as many smart minds attacking this as the standard methods have. There are important questions to be solved in estimating free parameters, in estimating initial conditions, and in achieving parallelism to run things fast, and creating standard software libraries and better data sets to calibrate against. Some of these problems I think we're starting to crack, like the problem of estimating free parameters and initial conditions, and actually, well, so rapid progress is being made in that domain now. I want to just stress that it really requires a different mindset, a different toolkit, a different skill set than standard constrained rationality models have used so far. And this is part of the reason why the change is substantial. It does involve going back to the foundations of what models are built on and the way the models are built and the skills that need to be had in order to build those models. I just want to stress that it is possible to do economics without assuming equilibrium, without utility functions or rational agents or perfect maximizers. So we'll see some examples in the session today. And I want to, where in this session, we're going to see a model of financial networks and systemic risk. Alyssa and Tom will present a model of macroeconomics from Stanislav Glau, who I hope is here. Not here. Okay, he's not here yet. We hope he shows up. Of the insurance industry, of labor networks, of money creation, and I put technology innovation down there because we have the pleasure that, you know, we have the father of agent-based modeling here. And Rob has made models of technology innovation among many other topics. So with that, let's begin. And Alyssa, can we get Alyssa's slides and Tom's slides up?
I think we're missing, yes.
Okay, good.
So, thank you, Don. This is joint work with Paul Nahai Williamson at the Bank of England, so I should start by saying that the views we express, of course, do not necessarily reflect those of the Bank of England. What we are going to talk about is how you use some of the methodologies that we are talking about today and tomorrow to improve stress tests. Now, what are stress tests? Stress tests are tools that you use to evaluate the resilience of, in this case, financial institutions against some kind of hypothetical adverse financial shock. Now, most of the stress tests that are being used at the moment are microprudential in nature. That means that they focus on a single institution in isolation. These models are pretty good at evaluating the initial effect of a shock on a bank's balance sheet, but they're not so good at seeing what happens through endogenous shock amplification. That's not strange because a lot of shock amplification that's endogenous happens because of the interactions between institutions that microprudential stress tests by design do not capture. So this has led to calls by by people in academia, but also policymakers, for what we call system-wide or macroprudential stress tests that model the system as a whole and include the interactions between institutions. But these models, although they're theoretically appealing, there is a clear need for more robust and easily implementable framework, as was recently a point that was recently made in a working paper of the IMF. So why is that the case? First of all, because the generic frameworks that are being used to model these stress tests and to run them in the simulation environments are highly tailored to specific context, and they're also very involved in the way they're designed and therefore very slow. All of this means that it's very hard to use a model that has been used in one context and then use it again in another context. So policymakers and academics working in this field very often have to start from scratch if they turn to a different context. And that's inhibiting the use of system-wide stress tests in practice. But then within the models that are being used, the financial models, there are also some challenges. The first is that it's proven very hard to model multiple simultaneously operating amplification mechanisms all together in one model. And the second is that there's a limit to which heterogeneity in institutions, in contracts, in regulatory constraints, in behaviors, and so on and so forth, have been taken into consideration. So we want to tackle these challenges, and we do basically two things, and we're going to talk about both of them today. So the first is we've developed a framework or a simulation environment for system-wide financial stability analysis, in which we have produced a generic method to model interacting contagion mechanisms, heterogeneous institutions, and multiple interacting constraints. This simulation measure has the advantage of also being very flexible, modular, and scalable in terms of the computer science and the simulation engine being sort of running the whole simulation. Now then what we're going to talk about is we're going to talk about how we implement this framework in a particular context. We have implemented this so far in many different contexts with many different central banks, and we're continuing to improve it. What we're going to talk about today is one specific calibration specific to to the EU financial system, and Alyssa will do that in a minute. So first a few sketches of what this simulation looks like. So it's built in Python because Python is relatively accessible for those that are not familiar with computer science. But we also have a simulation engine available in C++ if we want to run simulations at scale. So one example that we're working on has more than 1,000 agents and millions of contracts in one model. We also have a Python-based open source library that contains the key components that are common to many of these stress tests. And this library is in line with an ontology that we use to think about what financial systems look like. And that ontology we refer to as the building blocks of our simulation. So first we have financial institutions. Financial institutions basically are represented by their balance sheets. And these balance sheets are in turn populated by financial contracts that then also stipulate the interconnections between these financial institutions. So if you take these two building blocks, you already have your static network on which you can then run your simulation. Now, how does the system evolve? We need three more building blocks. First, we need markets, and markets are where prices are formed and contracts are essentially exchanged. We also have constraints. Constraints can be regulatory in origin, or they can arise from the payment obligations that are associated with contracts that institutions have on their balance sheets. And finally, given the limited space that then agents have left to make decisions after they have fulfilled all their constraints, we make behavioral assumptions for each agent. And the outcome of the simulation is obviously conditional on these behavioral assumptions. So how do we then implement this model? Well, we start with the European Banking Authority stress test scenario, which gives us not only the scenario, but also the first direct impact of the shock on each of the banks in our model. And we use this as a microprudential benchmark to which we compare the outputs of our system-wide financial stability analysis. Now, I can't go through how we implement all the 5 building blocks, but a few points are worth making. First, we have 42 banks, and we take the data to initialize that from the European Banking Authority's stress test. We also initialize hedge funds and asset managers on the basis of data from the European Central Bank Statistical Warehouse. Now, the second point worth making is that, as you can see, we include a variety of financial contracts and a variety of regulatory constraints. And so part of the heterogeneity that you see in the simulation comes from the fact that different types of institutions are subjected to different regulatory constraints, and that each institution is also subjected to different contractual obligations that arise from the contracts it has on its balance sheet. Now, finally, a quick word on how these institutions are initialized. You can see that banks have a range of contracts on their balance sheet, making it quite realistic, much more realistic than many of the existing system-wide stress tests. And you also see how banks are then connected to the other types of institutions. So banks are connected to each other through interbank loans. They're connected to hedge funds using repo contracts. And hedge funds, banks, and asset managers are connected to each other because they all hold tradable assets, so they have a common asset. Now, to tell you something about what we find running this simulation, I now hand over to Alyssa.
Thank you, Tom. Thank you, Tom, for explaining the framework and design of system-wide stress tests with a scholar's learning yet a courtier's ease. Also, William Haynes, thank you for organizing the conference, and Rob, thank you for moderating this session. I will proceed to discuss 3 pertinent policy experiments relevant to macroprudential policy making at the Bank of England. Policy experiment 1. This figure shows systemic risk, or in other words, the average fraction of bank defaults, as a function of the scaled EBA stress test scenario, for both the case of disorderly liquidation and the case of contagion-free resolution. Importantly, we show the evaluation of systemic risk by both the system-wide stress test in the colored lines and by the microprudential stress test in the gray lines. The key finding we observe is that the financial system might be stable or unstable given the same microprudential stress test outcome given by the gray lines, and this depends on its shock amplifying tendency. Therefore, microprudential stress tests are poor predictors of financial stability, and system-wide stress tests are absolutely necessary. Policy experiment 2. This figure shows again systemic risk as a function of the price impact and as a function of the scaled EBA scenario. A price impact of X% means that asset prices fall by X% whenever 5% of the market capitalization has been sold. We show this result for various usabilities of the regulatory buffers. For example, the orange line shows that if banks consider 25% of their regulatory buffers to be usable, then whenever 25 of their buffers is exhausted, they will act to avoid a further depletion of their buffers. The key finding that we observe from this plot is that the systemic risk decreases in an increasing usability of buffers. Policy experiment 3. This figure shows systemic risk as a function of the price impact for both the case of disorderly liquidation and the case of contagion-free resolution. In the top plots, we show how systemic risk decreases if you increase the size of the regulatory buffers compared to the Basel III standards. And the lower one shows it for the same thing for the case of the leverage buffer. The key finding that emerges is that the size of the regulatory buffers needed to confine systemic risk might be underestimated if calibrated with microprudential stress tests rather than with system-wide stress tests. Let me illustrate this point more starkly. Imagine that regulators would like to confine systemic risk underneath 10%. In that case, in the top plot, left plot, regulators would wrongly conclude that the Basel III buffers would be sufficient if they would use microprudential stress tests to calibrate the buffers. Whereas if you take system-wide effects into account, you actually find that at least double the buffer sizes are necessary to confine systemic risk underneath 10%. These 3 findings point to 3 salient policy implications. First, System-wide stress tests are necessary complements to microprudential stress tests to assess systemic risk, and further research in this area continues to be critical. As Tom mentioned, the IMF expressed its zealous search for robust and implementable frameworks. Our novel framework and our novel system-wide stress test software naturally expresses systemic risk. It clears what it shines upon, but it alters none of the integral structure of financial markets. System-wide stress tests dress systemic risk to its advantage. It is the only tool that naturally captures endogenous amplifications and thus systemic risk. However, to make system-wide stress tests truly usable as macroprudential policy tools, significant investments are needed. For instance, system-wide stress tests should be fully calibrated. They should include all parts of the bank's portfolios, including derivatives, and they should include also normal time behavior, for example, profit-seeking behavior. Second, the usability of capital is key to systemic resilience. It is not clear that banks consider their buffers to be usable, given that eating into their regulatory buffers comes with a restriction on their ability to make discretionary payments, such as dividend payments. Therefore, the design of regulatory buffers should be reconsidered. For instance, more parts of the bank's regulatory buffers could be made similar to countercyclical capital buffers. These buffers can, at the onset of system-wide distress, be released by regulators at no cost to banks so that they are truly usable. 3, the calibration of capital buffers should explicitly take into account system-wide dynamics. Greenwood et al. In 2017, they are from Harvard, argue that microprudential stress tests should be used to calibrate part of the bank's capital buffers. Our results show that this is not sufficient. The systemic risk part of the bank's regulatory buffers should be calibrated with system-wide stress tests. And this is easily implementable. For instance, currently microprudential stress tests are already used to calibrate part of the buffers under the Pillar 2 of the supervisory framework, and these can be easily extended. Let me make one concluding note. Napoleon once famously said, "One must change tactics once every 10 years if one wishes to maintain superiority." 10 years after the crisis, it is time to change tactics. Up to this point, we have been in a playground exploratory stage of system-wide stress tests. Now it's time to make a targeted push to make them truly usable as macroprudential policy tools. The crisis which is out of sight should not be out of mind. In this second great moderation, it's time to push so that crisis incidents do not govern policy, but macroprudential policy governs crisis incidents. It is the truest wisdom to be resolute and persistent to make macroprudential stress tests an integral part of the macroprudential policy toolkit. Thank you.
Okay, thank you, Alyssa and Tom. Whose slides are ready there? Torsten?
All right, thanks very much. So I'm going to be talking about an agent-based model of the insurance-reinsurance sector, which is developed jointly with Juan Zabuco and Dawn Farmer, both of who are here, both of who are from the Institute for New Economic Thinking in Oxford. Before I jump in, let me say a few words about Solvency II. Solvency II is a European insurance regulation framework, which was adopted in 2009, and after multiple delays came into effect in January 2016. It includes requirements for capital, liquidity, and transparency on the part of companies. It also includes requirements for risk modeling standards. Now, does this actually lower systemic risk? Of course, we hope so, that it does. However, consider one particular aspect. What if everybody, every insurance company, every reinsurance company ends up using the same risk model? which would be, let's say, the best one, but still an imperfect one. What happens in that case? So in order to investigate this, we built a comprehensive agent-based model of the insurance-reinsurance system, and of course it could also be used to address and investigate some other questions. There are a couple of historical events that led to the bankruptcies of a number of insurers to a scale that it would be relevant for the system. We listed some here, so the asbestos case and the Piper Alpha disaster and some more. For these, of course, the most important contagion channel is the counterparty exposure from reinsurance contracts, so that insurance-reinsurance companies interact directly with one another. However, in insurance, you have more contagion channels, one of which is the systemic risk from model homogeneity. So if everybody is using exactly the same model, then if that model is off, everybody is going to fail at exactly the same time. From the perspective of the individual company, that would look like this. Not only did our reinsurer just go bankrupt, but we are also in trouble at the very same time, and so is everybody else in the system. This is already pretty bad, potentially, because the risk modeling sector is divided basically between only 3 companies that matter, that have any significant market share. Now, the question that this entails is, first, how bad is this actually? Second, what would the effect of Solvency II be on that? And third, what can regulation actually do? So this is the outline of the talk. I will next give a brief overview of the model setup. Our model looks like this. There are 5 major types of agents. First, insurance customers in the bottom of this figure. They own properties. They will attempt to get insurance for their properties. They will pay premiums to insurance companies for this. Insurance companies, in turn, will try to get reinsurance for the insurance contracts that they have written. And these reinsurance contracts are excess of loss contracts by line of business. Line of business could, for instance, be hurricanes in Florida, which basically means the insurer will not reinsure the individual contract for the individual property in Florida, but all of the contracts that they have written in Florida combined. Now, if a catastrophe would happen in that peril region in Florida, and the damage exceeds a certain threshold, let's say $500 million, then and only then the reinsurance contract will kick in. And of course, they will have to pay premiums to the reinsurers for those contracts. Now, both insurers and reinsurers are able to engage with the financial market by issuing cat bonds on the one hand, and they will, of course, pay dividends to their shareholders. Now, you might say that the financial sector is kind of sidelined in this model. In order to defend that, let me show you a balance sheet of a reinsurance company. This is Munich Re, one of the biggest reinsurers that is around. Of course, you can't read that. The font size is too small, but let me highlight some of the things. This is basically the same balance sheet combined. If you look at the right side, the equity and liability side, you will see that the liabilities are not a significant part of the sum of that balance sheet. They just don't borrow very much. If you look at the asset side, you will see that the single largest position on that among these assets is listed as securities available for sale, which is a very, very liquid position, which basically means they also don't engage very much in investing in complicated financial instruments. So it is fair to actually leave the financial market out of the picture and investigate the rest of that. Now, what happens in a particular time step in this model is the following. First, there is a constant probability that a new firm might enter the market in this period. That doesn't change between periods. Second, the premium prices are set. They depend on the capital that is available in the market. Both insurers and reinsurers are modeled as price takers, so they don't have a direct impact on that. It is really just dependent on the capital that they own. Third, the damages from catastrophes and whatever occur, and the claims are filed accordingly. These claims will become due in the next period, where periods represent months. So the insurance companies will always have to pay next month. Now, each firm and each agent will first make all the payments that are due in this period. they will make underwriting decisions. So can we underwrite this particular insurance contract or can we not? And finally, they will request new insurance and reinsurance contracts if they desire so, or renew existing ones. And exit occurs on bankruptcy, so if a company goes bankrupt, or on lack of business. So the properties are modeled as belonging to exactly one peril region. That could, for instance, be hurricanes in Florida, or it could alternatively be earthquakes in Japan. And we model catastrophes such that they affect the entire peril region, every single property that is part of that peril region. Possibly to different scales, but they will affect everything that is in there. This allows us to design different risk models that are imperfect, so that they don't capture everything perfectly. They are actually different from one another, and they are of identical quality. We do that by having them underestimate risks in separate peril regions. So the first model will underestimate in peril region A, the second one will underestimate in peril region B, and so on. This, in turn, allows us to investigate different settings for the entire model in order to investigate the effect of risk model homogeneity or diversity, where the first setting would, for instance, be that we only have one risk model and every insurance firm, every reinsurance firm has to use exactly that model. Setting 2 would be that the insurance and reinsurance firms are split between 2 models, then between 3 models, and so on. Before I show you some results, let me address first the validation and calibration side of things. All right, thanks. Starting with the calibration, we have not calibrated this yet to real data. This is also linked to a difficulty of actually getting real data. As you might imagine, insurance, reinsurance firms are kind of protective of their data. But we are getting there, and we will do that in the next weeks and months. On the validation side, our model actually reproduces some of the stylized facts that are known from the industry very nicely. Some of those are in there by design, so we don't have negative money, and the risk evaluation is realistic according to what people from the industry tell us. Some of the aspects actually emerge in the model. So for instance, we are initializing all the firms as having the same amount of capital in the beginning, and a long-tailed distribution of firm sizes just emerges over the run of the model, which we actually also see in reality. We can reproduce a high insurance coverage. We can reproduce a number of other things, including also a realistic insurance cycle. Let me show you. If you just look at the lower panel in this figure, this represents the development of the premium prices as percentage over the expected losses as it develops over the years that the model runs. And the periods in the model are months, so these are about 1,000 periods. What you see here is basically that it does have a circular structure, that the period of that circular structure is a couple of years, and that the amplitude is more or less 15%, which lines up with reality. You can also see, if you compare that to the other figure, which on the same time scale represents the profits and losses, that it does not just mirror that figure. So there's actually something different in the model going on. Now, let me show you some of the results. On this slide, we again plot as a time development the number of contracts and the number of active insurers in the different settings. We plot that as a mean across 70 different replications for each setting. The setting with only one risk model is in red. The setting with 2 risk models is in blue. So as a red solid line, as a blue solid line, the setting with 3 risk models in green and with 4 in yellow. We also plot as a shaded area in red and in blue the interquartile range, so 25 to 75% across the 70 different runs for the 1 risk model and the 2 risk model case. What you can see is that the insurance sector is actually much larger and much more healthy in settings with more diversity. We can show that in these variables. We could also show that in other variables, but I want to show you something different, which is the distribution of sizes of bankruptcy events. Sampled across the 70 replications, with 1,000 time periods for each of the settings. From the upper to the lower graph, again, for the setting with only one risk model, 2 risk models, and so on. You can see that, and so this is basically the shares of bankrupt firms in the total of insurance and reinsurance firms in the industry. The vertical axis is just the frequency, the axis is logarithmic. So the vertical axis is logarithmic. You can see that the tail events are actually much more likely in settings with relative homogeneity. So you actually have much more probability mass over there, which basically means it's much more likely that you will actually see systemic events where a significant share of the firms actually go bankrupt. Now, let me briefly address, as a final point in the results, the role of reinsurance. On the left side, you see again the figure that I just showed you. This is the same figure. On the right side, this is contrasted with a simulation run that is exactly the same, only that we don't have reinsurance. So there are no reinsurance firms, there are no reinsurance contracts. What you can see in this case is that the problem of systemic risk of model homogeneity is actually much stronger in this case, because you have actually much more probability mass for the settings with low diversity in this case than in the other. I also included the slopes of these curves as an indication of how big the difference actually is. With that, I come to the conclusions. So we built a comprehensive agent-based model of the insurance sector. As far as we know, this is a first. There are some agent-based models of the insurance sector out there in the literature. However, they all focus on some very, very narrow and very, very specific aspects. Second, our results actually show that there is a systemic effect of risk model homogeneity, which does have implications for regulatory efforts, including Solvency II, because if those regulatory efforts are designed in the wrong way, then it may actually happen that everybody ends up using the same, albeit imperfect risk model, and that exacerbates a problem that is already there, which is that we only have 3 risk modeling companies that actually matter. The biggest one of that has a market share of at least 41%, according to a study that I saw a couple of days ago. So, and with that, I conclude. Thanks for listening. If you're interested in more details, please give me an email or just walk up and talk to me during this conference. Thank you.
Thank you, Torsten. So our next speaker is Francois Lafond.
So I'm going to talk about the agent-based model of the labor market, a relatively simple one. It's joint work with Penny Milley, Mariano Begueris, and Don Farmer, and it's a major chapter of Maria Del Rio Chanona, a PhD thesis at INED. So the motivation for this talk is that there's been growing concern about automation, the next wave of machine learning and robotics replacing many workers. But over the very long run, unemployment has hardly increased. That's fluctuated a lot, but not increased. So the relationship of technology with unemployment is more an issue of reallocation. And that's why we need to look at this. So here is a network representation of the empirical flows of workers between different occupations in the US. The point of this picture is to show that some job transitions are much more likely than others. You can transition from one job to another, but not to any other. So what does automation do? Here are the estimates from Frey and Osborne about the probability of automatability. That means whether the machines can actually perform the tasks in an occupation. For each of those occupations, in red, the high automatability and low automatability in blue. And what's striking is clustering. So the consequence of this clustering is that the occupations that are at risk are surrounded by occupations that are at risk. And we'll see that this can lead to bottlenecks in occupational mobility that in particular are likely to lead to especially long-term unemployment, people not able to find a job for quite some time. In the occupations that might be in relatively higher labor demand, there might be difficulties in hiring. But you need to look at detailed levels, and it could also be that you have a blue occupation surrounded by red, if you like, so there would be a high demand, but many workers are available from around. Or the other way around, workers might lose their job in a red occupation, if you like, but they can move easily because the accessible occupations are not under automation stress. So what we want to do is to design an agent-based model to understand these intuitions in quantitative terms. So we have something very simple. We have this empirical network of mobility flows, and we, for each occupation, define 3 variables: the number of employed workers, the number of unemployed workers, so they are the workers who were last employed in that particular occupation, and the number of open vacancies. So the realized labor demand would be the number of employed workers plus the number of workers that firms are trying to hire, so number of open vacancies. And this realized demand is something that we observe in the model, is a variable in the model that depends on the decisions of all the agents. In contrast, we define an exogenous sort of target labor demand, which is given by our estimates of how many workers are needed given the state of automation technology. And the idea here is that the firms in particular will behave, so will adjust toward the target demand. How do we do that? Skipping some details, of course, is that if the realized demand is less than the target, that means you don't have enough workers, well, you open vacancies. If instead the realized demand is greater than the target, workers are separated. And in addition to that, we also open vacancies and separate workers independently and at random. Now that some workers are unemployed and some vacancies are open, there's a search and matching process. The interesting bit is the job search. So each unemployed worker will consider all accessible vacancies. So they are the vacancies that are in occupations that are connected to an unemployed worker's occupation in the network. And these links are weighted. So the workers will choose one vacancy to apply to, depending on the ease of mobility as encoded by the network. And so, of course, most of the time, the most likely is that an unemployed worker will apply in the same occupation he currently is the one for which he has the skills. And then once all the vacancies have received some applications, one application will be chosen uniformly at random, or the vacancy can stay open if no application has been received. So that's it. That's the agent-based model. We analyze it as an agent-based model, so it's programmed in an object-oriented way in Julia. We have the empirical mobility network. We run with 100,000 agents, but even on a laptop, it can scale to 1 million. And because this model is relatively simple, we were able to write down the master equations. So the idea here is that you can think hard about the processes that you've defined for the model and calculate the probability that, let's say, unemployment goes up or down by a certain amount every period. And so you have then a system of stochastic difference equations. And in very simple cases, you can solve them in closed form, so that's very nice. But even in the most general case in which you cannot actually solve them in closed form, you can solve them numerically. Now, the good thing of solving numerically this equation is that it's still much, much faster than simulating the model. And that has the advantage that you can explore the parameter space much more systematically. So how do we precisely calibrate the model? We use the Beveridge curve. So Beveridge curve is a well-known fact in labor economics, is the negative relationship between the vacancy rate on the y-axis and the unemployment rate on the x-axis. Here you see data from the US. So in yellow, during the crisis, of course, unemployment rate went up and the vacancy rate went down. And then the other way around during the recovery period. So what we did is that we put in our model the target demand with some ups and downs. The model generates naturally a Beveridge curve. And we did that for many different configurations of parameters until we found one that gives us a very good match. So now we have a calibrated labor market model, and we're ready to apply an automation shock. So of course we don't know we don't know exactly what will happen with automation, but what we would want to put in the model is an estimate of what share of work will be automated or taken up by robots. There are two different estimates that we use. They are not estimates of what share of work will be done by robots, but they're estimates of the ease with which tasks in an occupation can be or could be in the future performed by machines. And they are quite different estimates. You see the histograms here. So Frey Osborne 2017 and Brynjolfsson, Mitchell and Rock last year. We really use these to understand the heterogeneity between occupations because anyway, we assume that the total number of jobs in the economy will stay constant. What happens is that the number of worked hours is decreasing. We do that because historically the unemployment rate has been stable and the working week has decreased, and we really want to focus on reallocation. So that's the result. On the top panel you see so it's the result for one occupation and one type of shock. On the top panel you see the way we apply the shock. So for instance, on the left, for the early period, it's based on empirical data, how many office clerks are needed in the US economy. On the right-hand side, you see the result of calculating what would be a post-shock level. And in between, we just assume a sigmoid, just to say that these processes don't happen overnight. And on the bottom panel are the results. So the unemployment rate on top and the long-term unemployment rates. That means being unemployed for more than 27 weeks. So we start the model in 2005, let it run for some time, converge to a steady state. Then we apply the shock. Unemployment rate rises in this case. And then it settles back down to a reasonable level, of course, because total number of jobs in the entire economy is constant. But this post-shock level can be different. So the interesting thing we want to focus on is really the transition period. So we're going to measure the unemployment rate in the gray period and compare it with the level before the shock. That's the result for all occupations. So the y-axis, again, is this percentage change in unemployment rate. So 100 would mean a doubling of the unemployment rate during the transition. And all the dots, all the green dots are the occupations, one dot per occupation. And they are ranked on the x-axis by the strength of the automation shock. So the first thing we see is that, of course, the more automation, the higher the unemployment rate during the transition period. That seems to make sense. The thing that's more subtle maybe is when we compare the results for the empirical mobility network with a benchmark world in which there would be no friction. So we have a complete network where agent can apply to any vacancy. And what we see there is that for the high automation occupations, mobility frictions make things worse. The change in unemployment rate is much higher. The other remark is about the scattering of the dots. So in the complete network, if you know the shock, you also know the level of unemployment. Instead, in the world where there are occupational mobility constraints, different occupations that have the same level of automation might have a completely different or fairly different level of unemployment. Why? Because it depends on their position in the network, whether they are surrounded by occupations that are also at high risk of automation or not. And the last result briefly is to, first of all, on the right, to show you that using a different type of shock, estimate of the shock, the results would be relatively robust, maybe less strong, but qualitatively similar. And on the bottom, I've shown the results not for the unemployment rate, not for the change in the unemployment rate, but the change in the long-term unemployment rate. And what we see if we look at the axis is that the results are much more dramatic. So occupational mobility constraints are really bad for long-term unemployment. And I'll conclude on that. The network determines unemployment rate in the aggregate and at the occupation level. And as compared to a world with no mobility constraint, when there are mobility constraints through the network, the occupations at high risk of automation are even worse off. And automation has a more dramatic effect on long-term unemployment than unemployment. Of course, there are many caveats and further work, so labor supply dynamics, wages, and aggregate growth and demand. So that's it.
Okay, we are now, our next speaker will be Christoph Seidenberger.
Thank you, Doin. Yes, so this is also joint work with Marco Gross from the IMF, so the usual disclaimer applies. This is not the opinion of the IMF or ECB or any affiliated institution. However, I do think that this talk is a good illustration, or this topic is a good illustration of how agent-based modeling is seen as an important tool increasingly in institutions like the IMF, because the impetus for this paper in particular was Marco sort of approaching us and saying, like, I really think that ABM is a great tool to help us make a very basic and fundamental point about banking. And this is what I'm going to be starting to talk about. Just really, what is banking about? So you would think after 500 years after the Medici, we would sort of like have a consensus view on that. However, if you've done any course on either financial intermediation, banking theory, or macroeconomics, we'll probably have heard at least one of those views that I'm presenting here very briefly. So sort of the first most basic view of what a bank does when it gives out a loan is sort of that it already has a deposit, it has some cash sitting there, and it just gives you that cash and sort of converts the cash into a loan. So there's no money creation going on here. The fractional reserve view, that is something you would see more in a macroeconomics context, sort of like it's having a similar idea, however, going a little bit more to the system level and thinking, well, if somebody is keeping cash demand for cash constant, if somebody takes out a loan somewhere, then at some point this loan will end up at the same or another bank's balance sheet as another deposit. So out of 100 euros deposit, so the bank has to keep, say, 10% reserves at the central bank, and it can give out another 90 euros of additional loans, and those will end up as 90 euros of deposit somewhere else. So and then again, 9 euros are deposited, so you get 81 euros lent out. So in the end, out of 100 euros of central bank money, you will see another additional 900 euros of private bank money being created. However, if you look into the real world, this is still sort of underestimating, because in principle, the multiplier here is 1 over the reserve rate, but in many countries the reserve rate is already 0, or so low that it's basically no longer binding, and we don't see infinite credit. And why is that sort of the actual view? And I'm going to go a little bit more in why we really think this is the correct view to approach it. Is that at the time that you go to a bank and you take out a loan, at the very instant, if you look at what's happening in the bank's books, is that this loan is being created, and at the same time a corresponding deposit is being created, and your loan is basically just money that is sort of you can claim from the bank now, but at the instant that the loan is being granted, it is just a deposit. So basically the bank has purely created money out of nothing. So this is really what some economists call fountain pen creation, because bankers use fancy pens, and then they sign the loan contract with a fountain pen. And these are 3 different views, and I'm not going to go through the literature in great detail, just to give you a brief overview. Really, if you go into the literature, and read the big names here, Keynes, Friedman, Minsky, all the big names, you will see them falling into all of those 3 categories. So these are really things that are sort of I think it's still valid to speak of 3 competing views, and still there's sort of a reason to make a point about money creation here. If you're interested, the slightly more interesting works here are highlighted in red. I just want to say 1 or 2 very brief things about the history. One thing about when I was saying that we have a strong preference for the money creation view, and as actually sort of all of these different views, if you think about what happens in a bank's accounting system at the time of loan creation, all of these three views would have different implications for what exact booking statements would be made at the time the loan is being granted. And actually, in 2014, a German professor even went to a commercial bank and took out a real loan, like in real euros, just in order, agreed with them, and sort of like really just studied their accounting system at the time before and after the loan was being granted, just to analyze the booking statements that we're going through. And again, they confirmed what we knew before, that this is basically the only view that is consistent with the booking statements that you observe in a real world bank is the money creation view. And in the literature, this sort of like, there is a bit of a cyclicality around this view, and we see especially that after like big financial crises, the money creation view enters back into the mainstream and becomes like the sort of like the predominant view of thinking about banking. And like very like market during the 1930s, when after the Chicago plan, after the Great Recession, the Great Depression, that was a very mainstream view. And like in the 1950s, things shifted more towards intermediation views and partly fractional reserve views. This is like, one thing is that central bankers usually tend to understand this problem well, and I just want to, like, this is, we couldn't really resist that. This is literally from last week's spring meetings, which we heard, IMF spring meetings, which we heard before on a panel with Benoît Correa from the ECB Executive Board. It's just a quote from him that about 90% of the money in the system is being created by banks. So it's just another, like, sort of like, anecdotal evidence of support of that there's sort of like there is understanding, at least in the central bank world, of the correctness of the money creation view. So what we're doing here, I was already saying from the literature review, we're saying like there are different views of money creation, and even within those of what banking means, and even within the money creation view, there is one thing that we find highly problematic, and it is what you will sometimes hear people saying, that a solvent bank cannot become illiquid, which makes sense if you think in a DSG world with maybe no banks or just one bank, because if a single bank with constant cash demand can just never become illiquid, because anybody who's trying to get money out of there and doesn't put it into cash, he will just give it to someone else, and so it just ends up as a deposit at the same bank. So it's just sort of like shifting the labels on the deposits, but it never really leaves the boundary of that bank. However, once you have more than one bank, of course you can get single banks becoming illiquid, because the money can be taken out of one bank and put in a deposit at another bank. And this is exactly what we thought that ABM is a great tool to sort of like just capture those dynamics and show that the money creation view is very much consistent with the need for liquid funding in a multi-bank system. So we have a very simple agent-based model. I won't go into the great details of how it's what it does. Basically, we just start every agent, household and banks are endowed with some money stocks, which we call outside money. This is sort of like, this is not money that has been created through the system. Then we have some real activity going on in the model. So agents, like household agents, like household and firm agents, they transact between each other. They take out loans. They repay their loans with interest. We have sort of like abstracted away credit risk in a way that, of course, like agents can have not enough money to repay their loans plus interest. However, like sort of in that case where we just block their spending until they sort of like are able to repay. So sort of like we've tried to abstract away credit risk because we don't want to go into that detail here. And the banks, what they do is sort of like, they charge interest rates in a way that they have zero profits, which is another simplification we'll come to later. But the important thing is sort of they net payments among each other. So the real activity is sort of mirrored by them. So like, okay, like I need to transfer money to the customers in another bank, and I get transfers incoming. And sort of like they exchange the net amounts, and whenever a bank sort of like faces a shortage of funds, of liquid funds, it sort of like uses its liquid reserves, and once those exceed those liquid reserves, it actually goes to the central bank and asks for liquid funding. So that's what happens in the system, in the model. This is just like a pure, like simple, this is like a single simulation path just to like give you an idea of what we're doing. I don't want to be going too much into detail here, but I wanted to show you sort of like, these are some variables, and these are the median and 10 and 90 percentiles of different variables. So on the x-axis, you see the number of banks, which is decreasing as you go to the right. So we're shrinking the system down to a singular system with only one bank. On the left-hand side, you have a big system. On the y-axis, you have the variables that are in the titles of those graphs. And the important thing that you see, like if you're like at the very right of the chart with one bank, you see that there are no banks ever go to the central bank and ask for funding, meaning they never have a need for liquid funding needs. And for liquid funding, so they never become illiquid. And we also see, due to the availability of outside money, actually sort of this singular system property even holds for sufficiently small systems in our calibration, about 20 banks. So it's not particularly like calibrated to data, but like the main findings that we want to stress here are very robust to all these parameters. And in the annex, we have a lot of sensitivity analysis if we're interested. So just want to highlight here that the financial variables, the interest rates, the refinancing activity of banks is highly dependent on the number of banks in the system. However, the real activity, the spending behavior is not affected at all, which to some degree is also a little bit due to the assumptions in the model that I want to highlight here. So I was saying, like, we have to say, like, it's a model we've made some simplifying assumptions, which makes the model very basic, but we think quite apt to make our main points. And so the main limitations are, when we're talking about interest rates here, they're being paid. If you think about what an actual bank interest rate entails, like if you go to a bank, what you ask for, then this will consist of different components. One component being refinancing cost is included in our model. Some sort of administrative cost that is included in the model in principle. It's not in the charts that I've shown you, but it's sort of like, it doesn't really change anything. It's a parallel shift, basically. There is no cost of risk, as I was saying. We've abstracted away credit risk. And very importantly, there is no cost of equity, no profit margin, which, this is very important, means that as we shrink the system, there is no competitive dynamics going on. There is no, even if we just have a single bank, this single bank won't extract the monopoly rent from the system. So this is a strong simplification. So we want to be cautious about the implications of interest rate dynamics here. But what we think, what is very evident already in such a simple model is that the money creation view is very much compatible with the need for liquid funding, with the possibility of illiquidity of solvent banks in a multi-bank system, where a multi-bank is not necessarily just two banks, but we also see that sort of sufficiently small systems can have similar qualities in the absence of bank runs, correlated liquidity shocks. Like, so we can have sufficiently small systems that sort of act as if it was a single bank system. This sort of like leads us to a somewhat natural definition of like sort of like distinction between banking and shadow banking. Bank lending and shadow bank lending. This is something just, this is a big topic right now in a lot of institutions like the IMF and the ECB, sort of like the risk from shadow banking. And if you look at common definitions of shadow banking, like the FSB definition, they usually put their focus on the fact that shadow banks are just not part of the official banking system, in the terms that they don't have a banking license, and they're not part of the regulated banking system. So it's very much a legal, putting the emphasis on the legal aspects. Our definition, sort of like our approach to this, goes more sort of like to the money creation view, where we say like bank lending is all lending that creates inside money, or we call inside versus outside money. If you think in terms of the model, that's outside money is money that has been that was the initial endowment, something that we started with, sort of like it's outside. It's not necessary, but usually you assume that this kind of thing in such a model. And inside money is all the money that's being created in the system. And bank lending creates inside money, whereas shadow bank lending is pure intermediation. It's those are pure financial intermediaries, and they do not create or destroy money. And if you think of real world banks, some of the activities that they do are also shadow banking. However, like the bulk of their business, granting loans, that is banking. And so this already leads me to the conclusion. So we have like a very simple agent-based model to make like a very simple point that first of all, we want to say like we think that money creation is the correct view, and if you look at what's happening in the real world banks, and money creation is very much consistent with the idea of having liquid funding needs. And and we see that sort of like this leads us to a very natural definition of shadow banking. In interest of time, I wanted to show you because I think it's quite a nice system because it's a very simple Python agent-based system. But I won't go in. And I know I'm getting turned here. The only thing I want to show you is I don't know if you can see like one line here is highlighted. These are literally like the booking statements that are happening in that system, and you can see like the highlighted line, which is the third black line from the top. It's sort of like you debit loans, you credit liabilities, and this is and you credit deposits, and this is exactly what's happening when you grant a loan, like in the real world, as has also been confirmed empirically. Thank you.
Thank you, Christoph. Okay, and did Stanislav? No. Not here. Okay. So, Rob, over to you.
Okay. So, I'll just take about a few minutes to summarize these nice talks here. I think we've seen a good portfolio of agent-based modeling as such models are used in finance and to some extent macroeconomics. Don't mention at the start that ABMs are often or can be viewed usefully as nonlinear dynamical systems. That's a useful way to frame, I think, some of the things we've seen here, primarily because much of what is done, as he mentioned, in DSG models, or what I think he called it constrained rationality models, you simply solve for an equilibrium or you solve for a fixed point. So in those kinds of more traditional models, you don't get the entire path toward, say, some stationary state or something. You solve only for a particular state. Let me just back up a little bit and say nonlinear is key to how Doan framed the thing. And I always like to use the following example. Many of you probably drove here to the meeting today, or if you didn't drive today, you drove some other time. If the world was linear, I mean, there are only three things that you do when you drive. You steer, you press the gas pedal, and you press the brake. If the world was linear, you could sit in your parking spot, your driveway, or your garage or something, and you could do the steering and the braking and the gas pedal in any order, and you would get to work. You could do all the steering first, and then hit the brake a bunch of times, and finally hit the gas pedal. I mean, the obvious point of saying this is that there's actually a very fine degree of error that you have in terms of how you press the brake and the gas pedal and do the steering in order actually to reach your destination. So the real world is incredibly nonlinear. The real world is kind of measure zero way to arrive at your destination. So modeling things that are not linear matters. Now this brings me to a general point about agent-based modeling I want to raise. Since we have a diverse group of people here today, we have economists and we have mathematicians and computer scientists and physicists. The word was used several times, simulation. So I just want to get this on the table that for those of you who are not economists, the word simulation in general in economics has been a very dirty word. And it's a very dirty word going back to what's called system dynamics and the Club of Rome that Bill mentioned this earlier, to say that in the 1970s, early models of environmental catastrophe of various types were written in a computer language using a computer methodology in which a large number of simultaneous, a large linear system was solved. Now, precisely because it was linear, the only thing that can really happen in a linear system is you're going to reach an equilibrium, or it's going to explode exponentially to some, to infinity. And so many of the limits to growth models, which were aggregate models, and they were not based on individual behavior, they were rather an aggregate of this depends on an aggregate of that. Those models basically showed explosive behavior, and it was later shown that as soon as you put natural regulatory devices into those equations, things like prices, which were not in the original model, then in fact you seriously constrained what could happen in such models. So you basically kind of brought the system back into kind of quasi-equilibrium steady state. So simulation got a dirty word in economics 40 years ago, back in the 70s, and I have to say it has not completely recovered ever. And so oftentimes the word that we use today are things like computational model or some way to differentiate what we do from simulation. But of course, what we do is a kind of simulation. Now, having said that, what you saw today, and what you saw illustrated here today, for those of you who are new to this paradigm, is you did not see, for example, when it came to the insurance market, for example, that was presented, you did not see a simulation of literally Munich RE, or when you saw a simulation of a bank, you didn't see literally the simulation of HSBC. So even though or for example, in my own work, when I simulate, when I model 6 million firms, I'm not actually simulating ExxonMobil and Citicorp or something, right? So in some sense, even though the models are simulations, they're not literally the meaning of simulation, where when engineers use the word simulation, right, they're saying, I want to simulate automobiles coming off the shop floor of General Motors in number and in quantity, et cetera, in quality. That's not what we're doing here. We're doing something different. And so agent-based modeling and simulation has the flavor of producing simulations, but it's not producing, right, the GDP of the U.S. tomorrow, or it's not producing even things like, you know, what Ford's net sales are going to be. So keep that in mind when you see these kinds of models. So as I mentioned, we have a broad portfolio on display here today. Some of them use detailed data. Other ones didn't have as fine-grained data as we'd like. These models can eat granular data, as we saw here. So several of them did that. They can be programmed in different computing languages. Python was mentioned a couple times. C++ once I took note of, and Francois mentioned Julia, which is an up-and-coming language. So you can build the models with many different systems. Arguably, this is either a limitation today on how fast the whole technology is diffusing, because there are so many different lingua franca, as it were, of the field, or maybe we need to homogenize on one. I'm not sure about that. We saw as few as a few banks being modeled, on the order of maybe 10 or less than 100 banks, but then also some in these models that were just shown. I think there was Tom and Alyssa talked about thousands of individual actors, but really millions of contracts. And so the scale at which the models can be rendered is quite large, and this suggests the diversity of what's possible with agent-based modeling. Without going into all the details about the models, it seems like this is, in fact, a representative cross-section, I would say. As an agent-based modeling specialist, I can say this is, when you go to a conference in this field, we generally see models that span these different spaces: qualitative data versus quantitative data, highly granular data versus things that are somewhat more aggregate, different programming languages, quite a different number of agents. But against the background of all that, I mean, what's on display here, it seems to me, are in fact, though, the major features of agent-based modeling, features that seem to offer it promise over conventional approaches. And let me just say that when I wrote a book about this topic 20 years ago, which has given me this, I'm not sure if I view it as a deserving title or not. I'm not sure. Maybe I want to be called the father of this area. But in the book that we wrote, we said there are four main ways in which agent-based modeling can contribute over and above the neoclassical paradigm. Is to say that we can obviously model heterogeneity quite easily. Now, in all of economics, we typically, all of representative agent, typically do not do a lot of modeling of heterogeneity historically. Yes, it is the case in general equilibrium theory. We can model arbitrary amounts of heterogeneity, but that is both its strength and its weakness. We can put any kind of heterogeneity in there and it's going to work in principle. We can give Marcus to clear, but then when we come to other branches of economics, we don't have so much heterogeneity. Also on display here today, as Doan has mentioned, is the idea of bounded rationality. That is, we have agents who are going to evaluate their local environment. They're going to have a decision rule to follow, and they're going to follow it. And we're not going to wait for them to compute the future history of their world, and then only take action when they have fully rational expectations about that world. They're not going to engage in what, for game theoretic terms, we would call fictitious play, for example. Typically not. Another area in which we've seen most of the models just discussed use the technology of networks in one way or another. I know we're going to have a whole session on networks later on, so I won't belabor the point, but to say that networks are an important topic, which I'm old enough to remember, I say half a generation ago, and when I was in graduate school, there was basically very little discussion of networks. Everything was well mixed. If a price was announced, everybody knew that price. If there was an opportunity available, people took it homogeneously. There was no heterogeneity present. And then the final point to say is that in the background of having bounded rationality and networks and heterogeneity, we very commonly will model disequilibrium, and so you saw that here. Many of the models displayed that as well. And so disequilibrium simply means that basically we're going to let people take actions independent of whether that will produce some perturbation. And many of the perturbations that get generated in agent-based modeling then will accrete and produce something that happens at the macroscopic, can potentially rise to a macroscopic level. And some of you will know the work of Xavier Gabex recently on looking at granular economies where microeconomic fluctuations can magnify up to a macroeconomic level. So I think I'll stop there and simply say this is an excellent representation of kind of cross-section of modern agent-based modeling, and I thank the speakers for their presentations.
Well, I'm hoping that people will come forward because I think we have ample time for discussion. Question there in the back?
Thank you very much. I enjoyed all the presentations, and I do see the point in agent-based modeling, especially in my field, which is monetary and macro. Now, I will only comment about two papers. One of them was about usable capital by Alissa and Tom, and the other one, of course, was by Christoph about how to model banks, actually. Now, first start with Christoph's paper. I'm really surprised. I'm coming from central banking in the past. I'm really surprised that especially the textbooks do not present the institutional aspects of banking correctly. So they are stuck with this money multiplier and reserve requirement modeling, which is a story of before 1980. After 1980, what happened was the central banking has changed. They have started using interest rates as their main instrument, and then they basically forgot about the reserve requirements. That's a big change, and that makes immediately your paper valid, because they can put the credit on the asset side, they can put the deposit on the liability side, and then the lender will transfer that deposit to somebody else. Let it be wage payments, raw materials, whatever. So money will be created. So what was the obstacle before 1980? Before 1980, the obstacle was they had to find the, let's say, 10% reserve requirement for that credit that they have issued. So that if that is restricted by the central bank, of course you go back to the textbook model of money multiplier, and the instrument is the reserve requirements, the base money. If the central bank is ready to lend that reserve requirement amount, even if it exists, let's say 2% now. ECB has 2% reserve requirement. If the central bank is ready to lend it, or if there are ample free reserves, like after QE, there's ample free reserves, so it's not a binding constraint. So they can just reduce a little bit from their free reserves and do the money creation and credit creation at the same time. So you are 100% right. And I am really surprised that this is not the mainstream institutional aspect of the modeling. You don't have a lot of behavioral. The chair talked about behavioral aspects. Should we use the behavioral modeling, or should we use constraint optimal? So you don't have that. You only model the institutional side right. And that makes a lot of difference. So I think everybody, all the models of banking, should be using that approach right now. Then the question is, what is the constraint? So can they produce infinite amount of money? The answer is no. Then that takes us back to Alissa and Tom's paper. They are subject to capital adequacy constraints. And if they do not have usable capital, they will have to stop at one point. That's number one constraint. Number two constraint could come from the demand side. If there is no credit demand, they will have to stop. So you see, all of these have to be analyzed in a realistic way even before coming to the behavior of the banks. So you should have to have the institutions right in your model. Then you can think about whether they are optimizing, constraint optimizing, myopic, or whatever. So first things first. That's why I like your model very, very much, and I recommend to all the modelers really to look into this Werner paper, 2014. It's obvious for me, but if you need empirical support, of course, you can look at that paper. Thank you very much.
Yeah, thank you. I think you've perfectly highlighted the point that I think central bankers really understand this, and I think you've perfectly summarized it, probably better than me. Exactly, fractional reserve banking is a valid concept as long as the fractional reserve requirement is a binding constraint. And afterwards, that theory would predict infinite credit supply, which of course we don't have. And as you say, there are different other possible binding constraints, real activity, or banking regulation, or even just internal risk management by banks. And yes, very much. And I would agree that this model, in terms of the real activity and sort of like the interest rate dynamics, there you should have like there should still be a lot more complication, like sort of like a lot more sophistication there. But like the core basic point here is really just about this point, that this is important, and actually it matters for the dynamics that we observe. Also, like in macro models, like which type of stance we take on banking and money creation. Thank you.
Yes, just a quick remark about using ABM in economics. Before I remind when I was a PhD, using ABM was really not well recognized. We say you should use mathematics, etc., because it's more serious. But there is something that is interesting to mention, is that it has been demonstrated that, for example, when you specialize the dynamics, for example, you take the specialized prisoner dilemma or something like that, the question of knowing which strategy will invade is undecidable, which means that if you are looking at complex systems where you have special dynamics, then very often there is no analytical solution, or you can demonstrate that you can have proofs that there is a general analytical solution for studying those systems. So in that case, simulating those systems in silico is the best way to study them. This is why ABM is so important, I think.
Comments on that question? Could you turn your volume up?
Sorry. Hello. I'm Teresa Farinha from Utrecht University, and I'm also studying the evolution of the workforce in face of automation. And I wonder if it would add to your model if you consider the other dimensions of relatedness besides similarities. Because we know through the multiplier effects in the economy that there are other ways of how professions influence each other in the system that is the workforce. For instance, if you have more doctors, you have more nurses. And not only through complementarities, but also through local synergies in big, complex cities. All these, the other dimensions of relatedness, they are influencing a lot how professions evolve. Thank you.
Thank you. Yes, absolutely. I think we have no estimates on complementarities or substitutability actually between different occupations, and that's a point that we actually raised to some of the people who produce the estimate for automatability, and so everyone is catching.
If I may, in that case, I would love to talk with you because we are taking care of this site, maybe. Thank you.
Just a couple of points. One is I really welcome the work on Inside Money, and I think that it continues a discussion going on for a very long time, and particularly, of course, it contributes to recognizing the radically misleading content of Hicks's version of Keynes known as ISLM. If money is endogenous, the system does not have an equilibrium solution. A second, and this may be beyond the scope of the insurance project, but one of the things that's going on in the new digital age is the generation of microdata that threatens the zone of ignorance in which insurance must operate. To have an insurable risk pool, we really need not to know and be able to specify the risks. Of course, if you have a healthcare system where insurance is underwritten by the state for everyone, regardless of pre-existing conditions, that is not a problem. Obviously, I'm speaking with an American accent, where it is potentially an enormous problem. And thinking about how one might introduce that into your, and I appreciate you're largely talking about commercial insurance, but introducing it into modeling the insurance industry could be a real contribution to public policy discussion.
So I have a comment and a question also for Christoph. I really like the money creation paper. A friend of mine in Toronto, working for one of the major banks, he decided to run an internal experiment, and he sent a question to many people at the bank to try to understand how they understood money creation. And the question was, if somebody walks in with a new deposit of $100, Canadian dollars, how much additional lending can the bank make? And the vast majority of people answered, suppose that reserve requirements are, let's say, 10% for the sake of the argument. The vast majority of people replied 90. The people who had read about endogenous money said 900. And only the people at the treasury desk, who are the people who actually manage the liquidities of the bank, they said, well, it depends. Because it depends what happens to the additional lending, right? If you assume that all of it is going to be taken out immediately, that's the 90, right? Because you're only left with 10. If you assume that it stays in the bank, that's like the one bank scenario. But if a fraction of it gets used to payments to other things, but then you also receive payments from other agents, then it's a liquidity management thing. So then you need to see how much. So you can do that. So I would like to see that experiment in your model. So put the extra 100 and see what happens. But that's not the question. The question is, you mentioned at some point the Chicago plan for banking. So the 100% reserve requirement. So did you do a version with that, and then to see what happens?
Like very much to that point, no, we didn't, because I mean that would kind of really run counter, because like the Chicago plan, maybe for everyone, it is the idea of, like, it's often called full money, for like taking away the money creation ability from the banking system, saying that sort of like all the loans have to be financed with 100% equity, and sort of like, and there's a 100% reserve requirement. So sort of like the bank really just acts like a piggy bank. You just put it there, and it's kind of the same thing as just putting it into the central bank. It's just sort of like, it's just the like physical or like virtual, your gateway to the central bank in a way. We didn't do it because like, it would kind of run counter to the idea of the model, because if in that model we take, it's already like very stripped down, and if we take away money creation ability from the banks, and there's kind of like not really much going on anymore in that sense, yeah.
But you can, because you can do 100% reserve requirement on demand deposits, and then have time deposits not be restricted to that. And then it's not money creation. You have to have people shift from demand deposits to time deposits and then lend, which is an alternative to that. So, yeah.
Oh, it's an interesting input. I'll note that down. Thank you. And also, like, very thanks for this anecdote. Actually, would be quite interesting if that's ever been like published. Because I think it is very important for like also people in academia to be more aware of how people exactly in the Treasury ALM departments actually think about giving out loans. Like, because of course, like sort of like in our models, cash demand is constant. Of course, in practice, banks are quite aware that sort of like some of that money will be flowing out, can be flowing out at some point. So there's maybe like a little bit more nuance to that still. Yeah. Thank you.
Thank you. I just first of all want to do this backwards now because of the conversation we just had. Rob was saying, you know, you have all these banks and so forth, we have to worry about them, and we can't model each bank. On the other hand, with Rick Bookstable, we worked on looking at heterogeneity in banks, and one of Rick's points is, in fact, in the financial market, there are a few very big actors, and those guys do actually have rules and ways in which they react and so forth, and they actually publicize them and actually emphasize what they do. So in one way, agent-based models can capture that, because those big actors, you can actually model what they do. So, and secondly, the other thing is when you put those big actors in, they're not big nodes, you know, on their own. They actually have things going on inside them, and desks interacting with other desks. And so the mechanics of that and how this desk reacts to that desk is important, and the overall reaction of the bank. We had a model of layman's like that, and it's very, very complicated, much too complicated for me to understand. And then the second thing is a question about the network model for employment. I didn't understand how this, you know, we always see these nice maps, these networks up there, but I didn't understand precisely how these things are being located with each other. So you say, Here there's a cluster where these are very unadaptable jobs, and then on the other hand we have this area in the middle. So if I'm in this part and I'm near a place where it's adaptable, I can move. But we need to know what the metric is there. Am I geographically near? Am I near in some sense in the same profession? And so you need to know a little bit more about that. And then my last question was for the insurance. What are the shocks that are involved? I didn't understand. Are these different shocks which are specific to each person who gets a shock, or are these shocks which are hitting everybody? So I didn't understand what the argument was there.
So it's excellent that Alan's asking some clarifying questions. So Francois, why don't you take first and then Torsten?
Yes, so thanks for asking. So this particular network we used, you could do this in two different ways. One is you can use, there are mappings between the tasks and the occupations. So you can say that two occupations are close if they share a lot of tasks. The particular network we used is a different one, is one that is simply the empirical data on what people do, what occupation they transition to. Now, in the empirical data, the network is almost complete. Is weighted, but is almost complete. There are at least one example of someone moving from any occupation to any other. So for displaying purposes, we use an algorithm that's called the maximum spanning tree, which selects or rather places the nodes in the space. And then we added only the links that were the most important, but that's only for graphic purposes. In the model, we use the actual likelihood of transition between occupations.
Did that clear up your question, Alan?
Not quite, because
well, turn your volume on.
Sorry. You might have two close things in that vision, which may in fact not be close at all in terms of what's possible for the individual. So he loses his job over here, and now he's faced with, oh, no, but it's okay because there are jobs available in Paris, and it's a very simple point, sorry.
Yeah, that's a good point. Somehow we also use that as an excuse for having only 100,000 agents. We're thinking of it as local labor market.
I think you are pointing out, Alan, that there's space. I mean, one could easily do geography too. Well, I shouldn't say easily, because then you would really need to make a much bigger system with more agents and take that into account. But it could be done these days.
So the shocks in our model affect the entire Peru region. So that could be compared to a hurricane hitting, let's say, Miami or so. So it's assumed that every single property that is part of that Peru region is actually affected. We draw the size of the shock from a truncated power law distribution. We draw the separation times from an exponential distribution. And we then basically distribute the value that is involved in the shock across the properties of the region using a beta distribution. So that's basically how it works. And then the insurance company that has insured some of the properties will see how much of the shocks actually affects what that insurance company has insured and how much the insurance company consequently has to pay.
Good. Answer you, Alan?
Yeah, so Alan, so you're exactly right about the surveys and about all the information that's out there for the bigger institutions, and we are aware of that too. And actually, central banks have internal surveys as well, where banks are asked how would you respond in this scenario, etc. And so we have actually been working with the Bank of England to use that as much as possible, because it's quite confidential as well, to inform our behavioral assumptions. And of course we can do much more in that field. So that point, I think, completely right. Another second point that you made was about the complexity within these banks and the trading desks. And that's kind of music to my ears, because we've been really working on this for years, and it's not published yet because we haven't finished. But there are two specific projects that we are thinking about. The first is about central clearing parties. And central clearing parties, of course, have a default waterfall and a buffer. And you can have that buffer in two ways. You can have it for all the different derivatives types, or you can have it per derivatives type. And you see kind of a segmentation going on within the clearinghouse, depending on how this is organized. And we're starting to take that into account with our models of clearinghouses. A second way in which we are looking at the complexity within is, in my doctoral thesis, I try and map out how these banks, what they look like in terms of their subsidiary structures, in terms of segmentation of capital, in terms of different regulatory regimes applying to different parts of the banks and to different desks, etc. We haven't worked out how to actually include that in our model. There are also major data issues there, but I think it's, it's a very, very salient observation, and I'm really happy you emphasized the point.
Just to add to what Tom has already said, in most contagion models or in most systemic risk models, indeed banks are considered as nodes, but they are not really nodes. They are thousands of nodes or 10,000s of nodes. And this has significant implications for financial stability. For example, we assume in our current model that liquidity can easily move across the balance sheet. But in past financial crises, that was not the case. You could have that there was a lot of liquidity in the Singapore office, but it actually couldn't reach New York where it was necessary. So really a next step is also to look to map out these in sort of both the inter-firm and intra-firm networks, and then make sure that the intra-firm networks are consistent with the inter-firm sort of dynamics.
If I could, Angus, I want to interject and ask Rob Axtell a question, because Rob, oh, sorry, okay, please.
Very brief. We had a meeting 10 years after the collapse of Lehman Brothers here, and John Llewellyn, who was the chief economist of Lehman's, said that he went to see the people on the trading desk and said, look, we've got much too much risk here. You have to start getting rid of it. We can't handle this. And they said, no, we can't get rid of it because that's what our clients want. It's high performing stuff. But we're going to take measures so that no problem, if something hits, we're going to clear this out very quickly. And then he said 2 or 3 days later, he went to a meeting of all the chief economists of the big banks at the time, and he started to talk about this to his neighbor, and suddenly there was silence in the room. And he said, everybody seemed to be listening to our conversation. And he said, what happened? And they said, we've had the same argument in every bank, and now we're all worried about the fact that we're all in the same situation.
So, Rob, I wanted to ask you, just building on a point that Alan brought up, you distinguished simulation, literal simulation, where you say, okay, this is ExxonMobil, you simulate all the companies verbatim and literally, and one could potentially do that for the whole economy, versus just representative things that are kind of like them. I guess it wasn't clear to me what point you were making about it. It seems to me that we should be working towards these literal simulations, because I think they would be extremely valuable, but I wasn't clear how you were.
I guess if you go back to your old stock market days, don't think about if we were, for example, even in the Santa Fe stock market, right? It's very hard to model the behavior of individual traders without knowing the algorithms they're using to trade upon, right? So in that case, there are certain kinds of ABMs that are probably never going to get to the representational level. But there are other ones, maybe right, with a big enough entity, you could. But just to piggyback on this general point and make take Alan's idea into consideration and considering the big banks. Of the 7 big banks, let me just report that someone who I know very well, someone who was on my PhD committee when I was in graduate school, went on to become the CIO of one of those 7 big banks. And he reports the following. He said that the CEO kept demanding that basically he wanted to have one screen on his desk where he could see the performance of the mortgage division and the equities division and the bond division. He wanted to be able to see the status of the company. And he kept being put off by his IT guy saying, that's too hard, we can't do that, we don't know how to do that, et cetera. Only when, in the US case after the crisis, we have this Office of Financial Research got formed, and they published data standards by which all transactions must be reported to a government entity, to the Office of Financial Research. Only after those federal data standards were announced did the CEO finally have the ability to have on his screen the status of all of his divisions at the same time. So that's an example where not only would it be hard, at least in principle, to simulate the behavior of the bank itself doesn't even know what its current state is. So that only recently has it improved.
So maybe if I could just interject a quick comment, because I think this is a really important point for this whole endeavor. I think there are a lot of cases where we can literally simulate stuff. Alyssa and Tom's model, that's what they're doing. We get data from the central banks. We have to go off to the ECB, run the model inside the ECB with data that we can't take out. But you can see what those banks are doing. You know what their binding constraints are. You may not know exactly what their strategies are, but you know enough about the binding constraints, we think, to get a very useful simulation. Similarly, in the insurance business, if we have the data on insurance companies, what they do is pretty generic. So I don't think the precise strategy of company A or B matters that much. And for the financial system, for financial traders, actually, surprisingly, in the US, there's something called a 13F filing where mutual funds have to actually say quarterly what they hold in their portfolios. And we have that data now for a couple of decades. You can backwards engineer, at least categorically, roughly what kind of behavior they have. And so we're actually trying to make simulations, not to predict the stock market, but for financial stability purposes. Because we have hypotheses like if there's too many trend followers in the world, then we're going to destabilize financial markets, volatility will go up, and to test those kind of hypotheses, because these are things that regulators could do to step in and say, wait a minute, guys, there's too much leverage now, you've got to back off because the system's becoming unstable. Christoph, you want to jump in?
Yeah, just quickly wanted to chime in because I found your comment hilarious in the bank that couldn't even map its own business. Actually, I just wanted to mention that sort of like, since, especially in the context of stress testing, actually stress tests, the introduction of stress tests was partly driven and partly design was actually driven by an intent to sort of exactly force banks to do that, to sort of get their own data in order. And so just the CEO could just ask, okay, like how much exposure do we have to Greece, to Greek sovereign at the moment? Because like, as you said, like they sometimes just couldn't do that. So that was actually sort of like part of the sort of like not so obvious, not so like well publicized agenda of like creating stress tests and forcing banks to do it bottom up. Yeah.
Thank you, and thank you to all the presenters. I thought they were an excellent set of presentations. I just had this sort of sneaking feeling that we might be missing the ghost of Denmark here by the way you framed this in terms of bounded rationality, because fundamental uncertainty plays quite an important role, and that's not in your constrained rationality or bounded rationality framework. And the tricky bit is it's fundamental to financial markets that we've been discussing. And I want to ask a question whether ABMs can deal with these situations where you have a sudden non-trading situation, that people just say, I don't know anymore, which was absolutely fundamental to the deepest point in the crisis, that people stopped making markets. It didn't continue that way. And whether you have to go to an open system, and so that doesn't work for ABM because you have some behaviors that are not defined, or whether you can build it so you have behaviors that are defined but lead to this outcome of no trading. So that's my first question. My second question relates, or it's more of an observation. I get a bit worried when the answer is ever higher capital regulations, because Alan Taylor's work across countries showing that there's no predictability of capital ratios. Of course, at Northern Rock, well, Northern Rock had the highest capital ratio in the UK and was the first to go down. We didn't have capital ratios before '88, and we didn't have systemic crises like this until 1930. It's not that obvious, I don't think, but it's a very convenient answer for regulators.
I'm going to jump in and answer your first question, because I remember being in Swiss Bank Corporation in 1997, standing on the foreign currency market making floor, and because we were doing a joint project with them, and there was suddenly a headline that there was a rumor that Boris Yeltsin had been assassinated. And it was quite fascinating because these guys are all trading like mad. They all look up at the screen. You can see them all going, what the fuck? They just didn't know what to make of that. And the trading just stopped. And the spread widened out. They all widened out their spreads because they just didn't know what to do. And they sat there for a few minutes. Nothing happened in the market. And then things came back and trading started up again. It turns out it was a rumor, and it was proven wrong. But, in agent-based models, of course, you would have to build that in. You have to have your agents going, oh, I don't know what to do. I'm not going to do anything. or I'll widen the spread. You can easily build in those kind of behaviors to the models. And we do have to worry in agent-based models when you really get down to the fine-grained level of transactions with a limit order book. If people don't throw orders into the limit order book, then trading stops. And you can see that happening. This happens in the real world, by the way, not just for things like Boris Yeltsin, but there are cases where you get crazy trades because there aren't any orders sitting in the book on the other side, and this kind of naturally emerges. So I think that's not a problem, though I think that understanding how to deal with fundamental uncertainty is a general challenge for everybody because it's hard to know what to do with that. Alyssa, you want to say something?
Yeah. So let me address the point of capital. Critically, a big part of our paper is talking about the usability of capital, not necessarily the level. So let me use an analogy here. Charles Goodhart once had a beautiful analogy which was about the Basel III taxi. So he said, imagine that you late in the evening come at the Basel III train station and you want to take a taxi to your hotel. And there's only one left. And you go to the taxi driver and ask, can you bring me to my hotel? And the taxi driver says, no, I can't, because there always needs to be at least one taxi at the train station. This illustrates that if you have a lot of capital, but it's not usable, it's totally worthless. And this is exactly what we're showing in our paper, that if liquidity buffers are in fact regarded as requirements, or capital buffers are regarded as requirements, then you get that institutions will try to take actions to avoid breaching that. And you get that what is individually rational, or what individually improves the bank's capital position by, for example, delevering, is actually collectively destabilizing. And as far as I'm aware, most of the papers that have looked at capital failed to distinguish between buffers and requirements. So then I also wanted to briefly come back to the point about no trading. So in our model, we do not capture that scenario, but we did look at how different market liquidity affects systemic risk. And one plot that I didn't get to shows that the more illiquid markets become, the more contagion mechanisms become mutually amplifying. So you get that sort of in a way which, so basically, this is a feature of complex systems that you cannot just add up systemic risk contributions of different contagion mechanisms, but actually they are greater than the sum of the parts. And this is especially strong when the markets become almost illiquid.
Thank you, Alyssa. Thomas, I think you were next.
I just thought I'd ask a question. These agent-based models, I imagine working in different jurisdictions where regulations are very different, the data sources are very different. There's so much disparity between the United States and the EU. But it sounds as though your initiative is really transnational, and I wonder if that's really true and whether you're able to merge models that work in different countries and study the interconnects between countries. Just a general comment, I wondered about to what extent your models are international.
So let me just respond very quickly. I mean, yes, I think one of the advantages of this is it's not so hard to retool your model for a different regulatory setup. If the rules change, you change the rules in the model and rerun the model and see what it does. So in that regard, I think things are flexible. Of course, you know, for calibrating models, you need to know what those rules are, and you need to kind of go one by one. And looking at John Muehlbauer, where I remember one of the cases this comes up is when you start looking at housing markets in different countries, people really, their savings and consumption behavior really is different in Germany than, say, the US. So it's not even just the regulatory regime that may change, but you may actually need to put in different behaviors that come from deeper sources. Maybe John, and then Bill, and then Simon, and then if we have more.
Just a brief comment on money creation. It seems to me that really credit creation and wealth creation are the keystones. Part of the reason for being interested in money creation is because one thinks money has spending power. But of course, wealth has spending power. And in your story, obviously it's a stylized model you were presenting to show some basic principles, but really in your story, there should be an addition that has to do with asset prices. So you expand, you lend more, asset prices go up. Because asset prices go up, particularly real estate, that gives you increased collateral. Increased collateral then generates the further ability to borrow, and then you have this cycle. It depends quite a lot on the nature of the system, the amount of leverage that's allowed to households and to the banking system. But the asset price component of that, which then has very large spending implications, that's really where this principle of money creation should be going.
Yeah, I think you're mentioning a great point, and I think exactly what you're saying is sort of like mirroring this sort of like model back into what stress testing models do, exactly like trying to sort of like capture these dynamics and the influence of the financial sector on asset price dynamics and other factors. I think actually one thing that unfortunately, like it was in the last slide with the Python code, it is actually quite interesting to think about. If you think in terms of when you give out a loan, if you think like just it's a really completely empty system and just give out a loan and there's just 100 euros now in the system, but you want 100 euros back plus 2 euros of interest. So where do those 2 euros need to come from in a way? And we start with outside money endowments, and sort of like what you can see that was sort of it was the balance sheet that was on the bottom slide. What you can actually see sort of like it's a reallocation from the borrower who takes out the loan, like after he's repaid with interest, and after the bank has paid out dividends, actually it's a reallocation from the borrower to the bank owner in a way like, which is an interesting dynamic. I'm not saying that the banking system is sort of like a rigid system to sort of like individual bank owners, because obviously like the reason why you would take out a loan is because you have some idea that you will be able to generate more revenue from whatever you invested in, or even if it's a house, sort of you think it from your labor income, you will be able to recover more from that. But it's actually sort of like, I think it's quite interesting sort of in terms of wealth dynamics also this aspect, what happens here, and this is what this type of model very, very neatly highlights. But you're absolutely right, like if you think about banking, you like slightly more close to the real world, you really want to think about asset price dynamics and like systemic risk in a way. Everything you do in like taking it more to the direction of what Tom and Alyssa are doing into the stress testing model. Thank you.
Yeah, very briefly. One, with respect to Rob, this is where we have to be careful what we wish for. So before the crisis, the CEO of one of the most visible banks in the world said exactly what you asked, what you reported before the crisis, and what he got were VAR models. He got value at risk with a normal distribution, and Gaussian copulas and catastrophe follows. And then just two reading list items, one for Alyssa and one for Christoph. The I Theory of Money by Bruno Meyer and Sanikoff, which highlights the paradox of prudence as banks indeed try to limit their exposure to each other, with the consequence that none of them can limit their exposure to the others. And on the other hand, with respect to what we were just discussing, Hyun Shin's lectures on risk and liquidity that demonstrate how and this is what John was pointing out, how the signature of a bubble is that the demand curve inverts, and then in particular, as asset prices increase, banks have excess capital, excess equity, and as he puts it, a bank with excess capital is like a factory with unused capacity. But in the case of banks, there is no limit to the ability of banks to create assets for each other and consequently drive the system into extreme disequilibrium, with higher prices producing more demand for assets.
Simon? Maybe the last question.
Thanks for the microphone. I don't think anyone in this session has yet talked about innovation or technological change. So I wanted to ask Rob and Dorian if you comment on what ABMs can do in helping us understand that traditional models can't. And especially how far can ABMs go in simulating not just spread of new technologies in the economy, but actual creation of novel
Tough question, Rob. You want to go
Right, so maybe Bill's the best one to talk about it, but when it comes to ABMs in particular, there are a wide variety of models that attempt to either model technology as an either open-ended system where the novelty can be endogenous, or ones more like maybe the Nelson Winters style where R&D begets you some incremental change. So there are a variety of models out there. It's one of the most active areas, I would say, of age-based modeling in economics. And so if you just, for example, attend the Society of Computational Economics meetings, you would see, 10 or 20% of the papers there would be on this particular topic. And it's a very active area with the goals being, can we model productivity and improvements? That's typically the goal of the work.
I guess I'd add, though, that I think it's the limiting factor is having good data about technological change and what it really does, and bringing those models, making those models actually well enough calibrated against data that they produce predictions that you trust. I think, well, Rob knows better than I do, but most of them, all the ones I've seen really have been very qualitative. Now, that said, I think there's huge space for collecting better data on technological change. And I think some of the patterns that emerge are pretty surprising. Maybe just to mention a few, and I'll come back and say a bit about this in my concluding remarks tomorrow. But you see wide diversity in rates of improvement of technologies. You see strong intrinsic behavior. Some technologies are just innately easier to improve than others. With a given amount of human effort, you'll see a lot more improvement. Moore's Law is the famous one. And you also see there's a lot of interaction. We've been spending a lot of time looking at, say, patent database, where patents are linked together by citations and technology codes. And so you really can see a network view, and you see that there are very strong network effects. Those network effects we have a paper we hope to finish soon showing that network effects actually have strong predictive value. And so you really need to think about an ecology of interacting technologies rather than just individual technologies. So that seems to emerge pretty clearly from the data. And I think there's a lot of space for bringing some of the more qualitative models together with quantitative models that actually could help us think about this is where we're going to have innovation next. I think that's an achievable goal in the next 5 years. And I think on that optimistic note, we're 3 minutes over, and we should probably go have our break. Thank you. Thanks, everybody, for their patience.
Okay. So can we start? Yes. Okay, welcome to this session on networks analysis. I am David Chaval-Arias, and I thank a lot the organizer of this workshop to invite me as a moderator, and I will do my best to put in to present my colleagues. I will start with 5 short minutes saying some simple things about the importance of networks analysis in economics, and after I will let my colleague to present more deep thoughts about that. So first, I think that we are in this session because economics is complex systems. So when you have a complex system, then the notion of networks is very important. Currently, a networks methodology is really at the core, as well with the ABM approach that we saw just before. They are at the core of the methodology of complex systems community. So when you look at complex systems, what you see is that so they are very diverse, but every time they imply some entities, for example, cells, animals, molecules, human text that interact at a various level of organization between each other. And this interaction makes the complex systems and its behavior. So one important thing to see in complex systems is that the space is very important. What are the range of the interaction? Are these interaction spatially constrained or not? If you are, for example, interaction between species, then the landscape is very important. If you have interaction on internet, then there is other constraints than the physical one we have in the physical space. So just a few things about how this importance of the networks and the topology of the networks is, how is it important in economics? Few things. First, when you look at social systems that can form ties without any constraints, like for example films or banking exchange and things like that, you see strong structures that emerge. Here I give, just as an example, a picture of the political landscapes on the Twitter sphere. What you see is every dot is a Twitter account and he's somebody talking about politics during the presidential elections, and they exchange some information via Twitter. What you see here is that if you analyze all these accounts that exchange information and you try to make some order of that, putting people that interact closely with each other close on this picture, you have this global picture of the French political sphere, and you see very strong structure appearing here with the color, which are the political party, and other more peripheral structure that are more distant interaction with political activists. So when you let a system, let it be economic or social, endogenously evolving with making ties between the agents, you end up with this kind of network with strong structure in it. And this structure strongly constrains what is diffusing inside these systems. For example, here you see the diffusion of a rumor in these political systems, where in red you have the Twitter account that relays this rumor, and what you see is that this rumor is very concentrated in few places of these networks. So if you think of economy, people interact, agents interact about their representation, their expectation, the price, and we should not expect more than having this kind of strong structuring about how people interact, how information circulates. So we are very far from an idea of having perfect information or even noisy information. It's just that information circulates very in small echo chambers. So this is one of the facts that this is one of the network effects that in economics networks are endogenously formed, and this we should expect strong effect of that. Another simple things, if you think of networks instead of thinking about, for example, pan-mixing interaction that was a standard model for a long time, is that you can take advantage of the network properties. this is a very simple example. If we want to vaccinate a population and you only can have 10% of vaccine for about the whole population, so you want to maximize the effect of your vaccination campaign, who should you vaccinate? And if you know that you are in a network and that a network of interaction, and you want to vaccinate the people that interact more with other people, so there is a very simple strategy to improve, to almost double your efficiency of your campaign if you don't know anything. For example, take these very simple networks of 3 people, 2 connected to 1. So the idea is that you take at random somebody and you vaccinate one of his friends. So if you do that, imagine I have only 1 vaccine to vaccinate this population. So I took somebody at random. I have one on over 1/3 chance to find the most connected one. But if I take somebody at random and ask him for friends and vaccinate the friends, I have 2/3 of chance to having the most connected nodes. So knowing that you are dealing with networks can help you to deploy better strategy to achieve your goals. So here you reach the most connected nodes. Another thing is that in networks, you have these contagion effects. So in economics in general. So usually we are thinking about domino effects. We'll see example more complicated. But domino effect is a very linear way to think, because actually in reality, things look more like that. For example, this is a film networks, where films are connected and interdependent. This is a work from Stefano Battisto. So we show that in such networks, then the contagion effects will be highly nonlinear. So we have lots of effects that are due to the network structure that we could anticipate and that can help us to better understand our system. So one example of nonlinearity in complex networks is that you have the percolation phenomena. For example, if you are in a city and you have only one source of water and you have to send it to all the houses, then you have one long pipe that goes to all the houses with a lot of ramification. Then if you cut some pipes, maybe still the water can flow. But at some point, if 2 pipes are endamaged, then there is a whole part of the city that will not have water anymore, because you reach the threshold where some part of the city is disconnected. So here you have a strongly linear effect that just before this last failure, everybody has water, maybe not as much as usual, but everybody has water. And after this failure, half of the city don't have the water. So you have this kind of things, which is phenomena, which is percolation. This also is all in the other way, when you have like a failure or bunk, or other kind of phenomena. At some points, some parts of the networks are disconnected, and because it is a network and you are looking at the diffusion of something, then the dynamics completely change. And when the dynamic completely changes like that, you can have a whole part of network which is disconnected and that collapse completely. So all the links between the nodes of that part are collapsing, and then it is very hard to restore the system as a whole, because abruptly everything is collapsing. So this is, for example, an idea of some non-linearity you can have in the systems. So some evolution can have in systems. When you have linear systems here, you can have given some condition and some system states, or here it's an ecosystems, you can have a slow degradation. So this is a good systems, good property. In other systems, you have abrupt degradation after some point. So this is some systems that are a little more difficult to handle. But there are even more surprising systems where you have strong linearity. So the system's condition is degrading. At some point, it abruptly falls to that branch here. And here, if you want to restore the system, you have to go back on all these branches, so to deploy much more energy to restore these systems. So these kinds of hysteresis often happen when you have some percolation phenomena. And so just to end with few things about networks. So we could talk about how about that, and my colleague will develop. But one interesting direction is also that now we are very fully aware that when you couple several kind of networks, then you add up other nonlinearities. So this is the multi-layer networks or multiplex networks or interdependent networks. So we can show that the way networks are coupled between each other, for example, the different product of a bank or the different transportation systems, can introduce more nonlinearities. And this can only be studied if you consider your system as networks. You cannot make like a continuous approximation or something like that. So because of all of that, networks analysis is very central to economic systems because in economic systems, typically you have agents that are isolated entities that interact with each other in discrete time. And all these phenomena and all the ones that we will see later have to be expected. So now I will give the floor to the panel. And so we'll start with Rajan Patel with textual complexity and prudential regulation. Thanks.
Okay, thank you very much. So yeah, my name is Rajan Patel. I work in the Bank of England's Prudential Policy Directorate. And I'm going to tell you about research that I'm doing with 4 colleagues from the Bank of England, James Brooks and Eric Valchak from the bank's Advanced Analytics area, and Zahid Ahmed Sharif and Nicola Garbarino also from Policy. And the usual disclaimer applies to everything that follows. Now, there is a general sense that banking regulation is complex, and that this might have adverse unintended consequences. For example, it might make it unduly costly for banks to comply with regulation. But there's currently not much evidence on how complex or how to measure that. Now, this is an empirical question, and until recently, the sheer size of legal text has constrained empirical work. So our research is using network analysis and other new methods to target some of these gaps. And here are our 3, or what we think are our 3 main contributions at this stage. The first is that we have built a new data set for text analysis. That is the universe, or near universe, of banking prudential regulation in the UK before and after the financial crisis in 2007 and 2017. This is about 600,000 words across 50 documents in 2017. This allows you to analyze all regulatory parts and their connections, and also to see how that has changed over time. Now, secondly, we take that text and we turn it into a network. So we use chapters of regulation as nodes, and we use textual cross-references between them as edges. And that allows you to see the hidden structure that is underlying this system. And thirdly, we start to measure the linguistic complexity of the regulatory text. So we are using text analytics to explore different dimensions of linguistic structure. Now, this work speaks to 2 literatures about complexity, one from economics and finance, and another from law and text analysis. Starting with the economics motivation. And this is particularly strong now, because attention is turning to evaluating all the financial regulation that has been implemented since the crisis, and really understanding its full costs and benefits, of which complexity is one. Now, the literature talks about how complexity in banking regulation can come from interactions between the good intentions of regulators and the challenges from the environment that they operate in, as set out here. Under intentions, just a comment on what I mean by being proportionate. This is about regulators wanting to choose approaches that are commensurate with risk, so not imposing undue burden. And the tailoring that this implies in regulation can create a tendency towards more precise and prescriptive rules. I've also mentioned 2 important environmental challenges. So the first is that banks have strong incentives to seek ways around regulation. And there is a literature that describes the kind of arms race that can result in between regulated entities and regulators who try to control ever-growing and newer threats. The second point is that different people are designing different bits of regulation separately, and they usually do that in a rush following a crisis. So it's inevitable that some duplication and some incoherence is going to emerge in a regulatory framework. Now, the key papers that I mention in the final bullet point are ones that think about the relative performance of simple and complicated regulations in a situation of uncertainty. But these papers are very focused on specific individual regulations, typically capital regulation. And Haldane, in several papers, Andy Haldane at the Bank of England, has said that the architecture of post-crisis financial regulation, so how all of this fits together, is something that really needs more work and more exploration. So that brings us to the second part of the motivation, which comes from law and text analysis. Now, there is a long tradition in law and economics about the best way of using rules, and in particular about whether writing more precise rules is efficient. There is a trade-off here, because if you want to specify all relevant instances in a rule, that is difficult without increasing the length and therefore the complexity of the regulation. Now, some new text analysis methods are just starting to bring facts to this debate, often inspired by the idea of treating a rule like an algorithm. And Lee et al. And Katz and Rule have done very interesting work here, combining networks and linguistic analysis on the US Federal Code of Law. But when we started this project, which was a bit more than a year ago, we couldn't see anyone looking at banking regulation through this lens. And the only bits of quantitative evidence that we found were on trends in complexity, were a few facts about how regulation had got longer. So just more words. Now, the data set that we have lets us explore some other dimensions of this, and I will show you what I mean. So this chart is our data set, the near universe of prudential regulation that applied to UK banks in 2007, that's the left bar, and in 2017, once most post-crisis reforms have been implemented. And the height of each bar is its length in words. So this data set is consolidating different elements of regulation authored by different bodies. It also records all the links between them, and we've used web scraping to do that. Now, the key things to be aware of here, on the elements of regulation, the chart distinguishes between rules and guidance. So you can see rules in shades of blue and guidance in green. Rules are legal requirements that banks have to comply with. Guidance is material that tells banks how their supervisors expect them to satisfy rules. Now, guidance has less standalone force, but the package of the two of them together is essential in a regulatory framework. You need both. The second point is on the multiple authors. Now, some rules in 2017 come directly to banks from the European Union, and that's the dark blue section at the top of the right bar. Other rules are written by national authorities, like the Bank of England. They either implement EU directives or there are our own rules. That's the lighter blue section. And we, national authorities, write their own guidance too. Now that's green. So what struck us when we produced this chart was that, well, the whole package has got longer. It's got about 35% longer since 2007. And that rate of increase is similar for rules and for guidance. But given the motivation that I set out, length isn't really enough to understand all of those issues. And that's why we turn to new methods. And I have two ways of illustrating this for you. And the first relates to this structure that we've outlined here. Now, this is a picture of that 2017 bar chart, but as a network. And it's, I guess, the kind of multiplex network, maybe, that was mentioned in the introduction. You can think of each node that's set out here as a chapter of rules or guidance, and a chapter is an aggregation that reflects the drafter's choice about common subject matter. So, for example, one of the nodes in the UK rules layer is all the rules on algorithmic trading, for example, in the UK. The links are textual cross-references between the chapters, and you can see that these span the different source documents, from the EU rules to the UK rules to UK guidance and back. So in a system like this, regulators need to be aware of what we're thinking about as ripple effects. So that is interconnections between these bits of law that will affect policy transmission mechanisms. And these things can also amplify the effects of any policy error, which you wouldn't see if you were just looking at regulation as one homogeneous body. The second illustration of why length isn't everything relates to the language that regulators use to express rules. Now, rules are tools to achieve policy objectives, and policymakers will consciously use rules with different language structures to achieve different things. Now, this stylized picture, and it is very stylized, is showing you just two dimensions of language structure that come up in the literature. The horizontal axis is about how many facts does a rule specify, and the vertical axis is about how precisely those facts are specified in a rule. Okay. And here are two rules from actual banking regulation that we've positioned in this framework. So you can see in the bottom left that a short rule can be complex to interpret, because what is actually meant by adequate? There's some judgment there. In the top right, a rule that is not particularly long by the standards of the overall rule book is actually quite complicated because it has many conditions. There are many things that a firm needs to think about to understand what it means. And we've started using natural language processing ideas to get a handle on these different dimensions. So turning to the results, first on structural complexity, and then speaking to linguistic complexity. Now, structural complexity. The left network is in 2007, the right is 2017, and as a reminder, each of these nodes is a chapter, text that talks about a common issue. What stands out is how policymakers have reorganized this network since the crisis. It's gone from being a single layer to multiple layers. In 2007, everything was written by the UK regulator, including our implementation of EU directives. In 2017, it's expressed across three sources: EU, UK, and UK guidance, with connections between them. This means that the units of observation, these chapters, have changed over time. A 2017 chapter is not the same as a 2007 one. But we think it makes sense to follow what drafters elected to do when we set these kinds of visualizations out. Now, we've summarized this network with two statistics that speak to our interest in ripple effects. The first is degree count, and the second is page rank. And here are distributions for those two measures across all nodes in the network. Now, the degree distribution, which is the left chart, is simply the count of the number of links into and out of each node in the network. Page rank, which is the right distribution, or the right plot, counts the number and the quality of links to a node to assess its importance. So nodes that receive more direct and indirect links score higher. And the measures confirm sort of what you got from just eyeballing that network, that in 2017, indirect connections are becoming more important in determining this structure. The degree distribution has shifted to the left, and the page rank distribution has shifted to the right. So those ripples, determined by the interconnections between different parts of law, are probably more important in 2017. And now some measures for linguistic complexity. So I started by showing you this spectrum, and we've built a suite of measures that speak to these dimensions and a few others. And here are the 4 measures that we're taking to the text at the moment. Now, the first one speaks to precision. How many different concepts are there in a rule or a set of rules? And we measured that by lexical diversity, which counts the relative frequency of unique different words in a body of text. The second, which speaks to the number of operative facts, is conditionality. What is the relative frequency of conditional statements like if and but? Because these require, well, more judgments on the part of the person interpreting the rule. The third is a measure of overall cognitive cost, just how hard is it to assimilate what a rule means. And we used the Flesch-Kincaid grade level score to get a handle on that. And the fourth is just length, which really tells you a bit about all of the above. Now I'm going to show you sets of plots for the first 3 of these measures, and I'm going to start with the conditionality metric. And what we've done here is calculated that conditionality measure for every chapter in the network that I showed you, and we've shown how the distributions of those scores vary across chapters for rules and guidance. The light blue is in 2007, the dark blue is in 2017, and you can see we differentiate between rules and guidance. Now, what stands out? Conditionality has increased across both rules and guidance. Intuitively, maybe this is consistent with regulators trying to be more risk sensitive. If you introduce conditionality, you try to identify more states of the world, more characteristics of markets and banks, and you make your rules accordingly. I'll very briefly show the 2 final distributions and then I'll stop. The second measure we have to show is lexical diversity. How many different concepts are there in a single chapter? And here you can see the scores are pretty similar on average between 2007 and 2017, although there's more action for guidance than there is for rules. Intuitively, it suggests not much change since 2007 in the richness or the granularity with which regulators express each topic. So we might be now thinking about maybe capital and liquidity, but are we thinking in a more refined way about credit risk within capital? Maybe this gives you a handle on that. And finally, the same idea but for readability. Overall, it looks like the framework is less readable, again driven by guidance. So these 3 points, I think, set out our key messages. The text grew, language has become more conditional and less readable, but there are no more concepts within each chapter, and the network has really changed and lengthened, with indirect connections becoming more important. I'll stop there because I'm over time, but I would welcome questions on what we're going to do next at the Q&A. So thank you.
Thank you, Rajan. So now we will go directly to the next talk, and we will have some time to ask questions after. So now we have Gert Buiten, senior researcher, and so I will not adventure to give the name. So, but on methodology for estimating the Dutch interfirm trade networks.
Thank you.
Sorry.
Thank you very much. First of all, I must apologize. My colleague Sjoerd Hoijmaiers couldn't be here, unfortunately. I work on this project together with him, and he did most of the programming and a lot of sorting out the technical details. But anyway, he is not here. This research that we are doing is part of a program that we started about 3 years ago at Statistics Netherlands to see what can we do as official statisticians with complexity theory. And during that project, we started to investigate what we could do with agent-based modeling, and we started to develop 2 sets of network data sets, one on a data set on the network between persons and households, and the other one is what I'm going to talk about, the network of interfirm trade between companies in the Netherlands. I think I'll skip this one because we've heard so much about it already. The economy is basically a network phenomenon. So you really want to have network data as much detailed as possible, at least as if possible at the micro level. Possible applications, I'll be very brief about this as well. You can of course describe the structure of the network, but you can also detect and describe clusters, like for instance Silicon Valley or groups of companies from different industries working closely together, supply chains even, or also regional analysis is a very important thing, but you can also analyze resilience, vulnerabilities, systemic risks. But one important thing, if you have a good micro data set, you can also use it as a basis for agent-based models. One of the issues that, one of the possible applications that we stumbled more or less upon in discussing with one of the major Dutch banks is say if you can have high frequency payment data, for instance on a weekly basis, you can actually see the motion of activity across the economic network. And last but not least, when you have such a micro network, you can also use it to improve existing statistics. So therefore, at Statistics Netherlands, we started to think of how can we develop a micro network when, as is the case in the Netherlands, there is no real big data source that can show you that you can use as a source for estimating such an interfirm network. Whereas, for instance, our neighbor Belgium has VAT regulation where companies just have to report on an annual basis who their domestic trade partners are. So you can quite easily derive the network. In the Netherlands, this is not the case. We have to resort to a different approach. And what we set out with that we need a method that can combine various sources and that can also impute missing links. That's the only approach available to us. But also, one of the advantages of the approach that we chose is that you get a breakdown by commodities as a byproduct. And of course, this method, because of the flexible approach that we chose, can be used by more national statistical institutes. So we hope that we can inspire some of our colleague institutes. I must say this is still in the laboratory phase. We're still working on the software, and we're now we got a limited amount of data on actual trade relations between companies from a firm called Dun & Bradstreet. But we're now trying to develop, to derive the first data set and start analyzing it. So for us, this is a nice start. Basically, the approach that we chose is that you can estimate or try to estimate the probability that two firms have a link. And in order to do that, you can use various sources of information. The basic approach is inspired by a number of or a big body of literature started from the financial crisis, where all sorts of networks were estimated between financial institutions. And this is one of our inspiration sources. Another starting point for our approach is that, of course, at Statistics Netherlands, we do have a statistical business register. So we have all the nodes in the network in our register. And we also have information on, for instance, which industry these companies are. We know how much turnover they have. We know how many people they employ, etc. So if you have no other information, then you can say, well, okay, I just assume that every firm has a connection to another firm. As you can get the adjacency matrix on the left hand of this slide. Each cross, of course, there stands for a possible a relation between two firms, but obviously this is not the real world. You want to get somewhere to a picture that looks like the picture on the right side. So basically, you have to add information to delete crosses. What we try to do there is to, first of all, get to auxiliary information, and one of the major sources for that are the supply and use tables that are in the system of national accounts, and basically every modern country has these data. And the supply table shows you the commodities that the Dutch industries supply. And the use table shows you which commodities are used by these industries. So if you also have the microdata on the different firms, then of course you can copy this to a micro level, and then you see the basic structure, but translated to the individual firms. this is one step. But of course, we also have a number of statistics like the structural business statistics, we have the Prodcom statistics, we have in a number of cases information of, for instance, client records, customer records from companies. Companies have to keep track of who their debtors and creditors are. So there's quite a lot of information that you can use to delete a little bit more of these crosses. And so you can narrow down the range of freedom when you start a matching process. Well, these supply and use matrices, the enriched versions, go to the next stage, which is to add observed links. These can come from VAT data. The Belgians have such type of data. I think even Estonia has it. But we can, in the Netherlands, we don't have these data, so we're now discussing with some of the major banks to get access to payment transactions data between their business customers. And they quite often already use those to extract networks for risk assessment. And I think also the ONS in the UK is now discussing or even started a project with Barclays. And in the Netherlands, as I said, we have access to a data set of Dun & Bradstreet, who have, for about 500 large Dutch companies, information on the trading partners. To use them in this operation, you will have to break down these firm-to-firm links into firm-to-firm links per commodity. And therefore, we use the structure from the previous slide, where you have broken down turnover and purchases by commodity. That goes to the next stage, but of course we already had this data in the supply and use matrix from the previous one. So to avoid double counting, you have to make an adjustment, and then you go to the next slide with use matrices enriched and adjusted, and observed links with a breakdown by commodity. So this is what you have for the final stage, and this is of course the most important one. You want to match and combine the missing links by performing a matching procedure for suppliers and users per commodity. And of course here it counts that you can only link two firms if the one supplies a commodity that the other one uses. So you, from the enormous range of degrees of freedom from the very first picture, you really now have a much more precise linking process. In order to do this properly, we also add some more auxiliary data and assumptions. And one of these auxiliary data comes from the input-output tables, also from the national accounts, which for instance show you, as in this picture, that industry number 2 does not sell anything to any company in industry number 3. Okay. So that quite helps a lot to delete even more crosses. And when you have done this, then you can combine the two. You have basically a full data set. And of course, now you probably want to know more about this matching procedure. This one was inspired by agent-based models where market clearing mechanisms are involved. We use it in this way. We look at, for a specific commodity, which firms do supply this. We rank them by a score that represents the likelihood that this firm will supply this commodity to a specific using firm. The using firms are ranked by size, and then in a top-down procedure, the market is cleared for this commodity. And well, the connections that are made now are removed from the list of in-degree and out-degree per firm that we use in this procedure. I'll not explain much more about that, but this is the basic approach. And of course, well, for instance, especially we have to use this in and out degree to limit the range of degree of freedom, and we calculate this from the number of commodity and firm combinations in the supply table with an adjustment factor that is based on an assumption. The score that we rank the suppliers with is based on a number of assumptions and parameters, and three of the main parts are mentioned here. The phenomenon of assortativity. Large companies prefer to trade with large other companies. There's a strong power law distribution in the in and out degrees that is linked to the size of the companies or their turnover, for instance. And also from the literature, geographical distance quite often plays a role in which companies trade with each other. So these are included in this ranking procedure. Well, if you have this basic set of firm-by-firm relationships by commodity, then you have to distribute the weights from the supply and use tables to arrive at weighted relations. You have to aggregate it to a firm-by-firm network, and you have to publish in such a way that confidentiality is guaranteed. And we're not as far as that, but this is really an important thing. And finally, further research. In the Netherlands, our main priority is to get access to more data. And so we have ongoing negotiations with the major banks. We're talking to departments that have the data, and they are willing to share it with us, but there are all sorts of legal and corporate and et cetera, issues. We are making steps forwards, but this is a slow and tedious process. But we'll get there, I'm quite convinced. I mean, also in this respect, we have to develop methods to aggregate data on payment transactions by one-person firms, because they are, under the GDPR regulation, those are personal data, so you have to protect them. A second step that we want to do is regionalization of firms with several local establishments. And last but not least, we want to investigate the quality of the imputation procedure and probably also improve it by doing a sensitivity analysis by using different parameter settings, validate and calibrate the approach, and compare the imputed data with real data. And that is my presentation.
Thank you very much. So we even have 1 minute for one or two questions, and we will ask a small question. If there is one question now, we can take it. We have a minute. Or you prefer to have time to prepare your question? Okay, so in that case, yeah. No, for that presentation. After we will have question for every. No, it's okay. Okay, so we'll go directly to Tom Hurd on systemic cascades and in financial networks. So Tom, I'll give you the floor.
Okay, thank you, David. Let me say it's a great pleasure to be here, and it's especially a big pleasure to see all the international participation, the United Nations that are involved with the economic challenges. I guess it's the wrong one. Okay, so, I'm keenly interested in systemic risk. Full disclosure, I'm a mathematician, not an economist, but I have been working on systemic risk for exactly 10 years now. So let me start with the definition, just because that's the way mathematicians think. So systemic risk is the risk that default or stress of one or more financial institutions will trigger default or stress of further institutions, leading to large-scale cascades of system failures and a negative impact on the external economy. So to clarify, I think of these as crises that are relatively short-term because the finance industry moves very quickly. But it's core to the economic system, and so so people have said that banks are special in the economy, and Kindleberger and Minsky feel that the most important triggers for economic crises would be heavily concentrated in the finance industry. So my personal aim, and I represent kind of a small group of people, unlike Doyne Farmer and the Oxford group, which is very impressive. But I'm aiming to do something a little different, which is simpler to make it easy to have a consistent framework for systemic risk that have these same attributes that others have mentioned: tractability, scalability, and reality. The purpose is to learn and inform the debate and maybe test new heuristics. And since we're here, I really now in the past few weeks have been thinking we need to have a global systemic model that is kind of a standard model for the whole global system, because the international connections are a big factor in every economy. So, excuse my hand drawn things. I had some pencil crayons. I have no facility to do these things on a computer quickly enough. But here is let's think of the system as banks with balance sheets. So those little rectangles are the balance sheets, assets and liabilities. And the pipes between the banks are multidimensional. I've drawn 4 lines there going both directions. The different colors, it could be repos and it could be loans or different qualities of links. So we have indeed a multiplex network in the sense pointed out. How complex is the system? Well, we know this. And financial system is incredibly complex. Just to quickly touch on some of the difference. So banks could be regulated and unregulated. They're hierarchical institutions, so they're actually networks, as we observed in the previous session. So links and exposures themselves are highly complex portfolios. The big banks trade so many different products amongst themselves. They have a portfolio between each other, and the global banking systems are indeed strongly connected. Bank strategies are highly dynamic. Their decisions are made under great uncertainty. They're not very aware of the actual plumbing of the system itself. I just say banks are special again, well known. They occupy the heart of the macroeconomy. And furthermore, the system is opaque. Fundamentally, it's a strategic network, and nobody shares information willingly. And as an academic, I experience that all the time. I don't know what the links are like. For mathematicians, we try to strip away whatever complexity we can. So we reduce the balance sheets to 3 different elements on the left, asset side, and 3 different elements on the right, the liabilities. And because we're systemic people, the most important thing are the interconnects between other nodes in the system. So that's why the interbank assets and the interbank debt are the top element. And then every system has an exterior, which is it is part of the model, but it's just we don't choose to model it in the same way. So there is an external economy outside the system, and there are assets and debt attached to the external of the system. And then the bottom, on both left and right, I think of as buffers, and these are flexible balance sheet portions that provide shock absorption due to the uncertainties in the trading, in the securities network. So on the left, we have liquid assets, which is C for cash, and on the right, it's market capitalization, equity, or shareholder value. And when the shareholder value goes negative, that's generally interpreted as a sign that the bank needs to be put into insolvency, and so that's a hard constraint that modelers generally impose, that a bank will be insolvent if the equity is ever negative. Negative cash situation might technically arise, but that will be a source of that's where we're going to focus. So in red, I've written buffers, a sigma and a delta. Those are the objects of attention in systemic risk. These are the safety buffers, and in a crisis, they go technically negative for some banks. And so in a certain sense, a crisis is a time when these accounting laws are no longer sustainable, and the system itself has tried to resolve the situation of negative buffers happening. So that's kind of a mathematician's shortcut way of thinking of a crisis. So a paper of mine recently, I'm quite proud of this picture, which was trying to capture the leading flows that are responsible during a crisis for the propagation of shocks and stress. And notice the middle band is this financial system, and the two wings of the picture are the exterior. And I intentionally made it a very symmetric picture. At the bottom of the picture, there are the default buffers, the deltas, and at the top of the picture, there are the cash buffers, or the liquidity. And so there's, during a crisis, you expect circulation. A liquidity crisis would be the L in the upper part of the paper, where banks are short of cash, and they protect their cash, try to recover cash, and they impact other banks in the system. They recall money that is owed to them, and that's a transmission of shocks around the L circle. The bottom S represents a solvency cycle, where when some banks become insolvent, they also have to restructure their debt, and this causes shocks to other banks. Now, the big loops around the outside on the left, I'll just quickly say that that's what I call a bank panic, where the debt pool, the funding agent, the external, the wholesale funders of the banking system detect that the system itself is going into a crisis mode, and they pull money, capital, out of the banking system. And on the right-hand side, dual to that, the fire sale channel is banks trying to raise money will liquidate assets, dump assets in the market, which will create a negative price spiral, which will then impact the asset valuations of all the banks, weaken every bank in the system. So maybe that's too long of an explanation, so I'm going to go more quickly. So I said that I wanted a simple to explain system, and I've worked on the problem for about 10 years, and what's new, I've decided that how I explain, or the modeling approach that I had been using up until a few months ago, was unnecessarily indirect, and so I focused on something called inhomogeneous random financial networks. The basic idea is it's random because data is missing. So we really don't know the essential elements in the network. So there's a concept of bank types, which includes, importantly, the country that the bank is in, the size of the bank, the type of bank, the category of bank. But we have a finite number of banks of all different types. Now we have a random skeleton, which is just the interconnect, which Herd just was describing for the Dutch firm network. So it's a random network because at a moment in time we don't know which are the important exposures. There are the balance sheets of banks themselves, which are in a sense random. There's the exposures that are random. And in addition, we'll make this an agent-based model by proposing that the banks during a crisis behave in a stylized way, which is not their normal behavior in a normal situation. So there's all these ingredients. So, okay, very good. So the paradigm for probabilistic modeling of a crisis comes from the Eisenberg-Noe formulation. And so I worked, so this is extending this picture of clearing of balance sheets imbalances in a network situation. So let's just say that it boils down to iterating the banks respond to the current state of their balance sheet, they make an adjustment, and then the whole system has to update itself. And so you go through this series of steps, and ultimately convergence will be achieved. So in the end, the crisis slows down to a new normal state. So here's another handwritten picture. So a given bank in the system during a crisis is going to receive shocks coming in from the left in this picture from all of the banks in the system. And I just break down the cascade mechanism into a couple of steps called aggregation, absorption, and propagation. So the shocks hit bank B, there's some sense accumulated up into one big shock that is sustained by the bank, which then creates a certain measurable distress. It's absorbed by the bank, but the bank is stressed, and as a result of being in a stress situation, it will then propagate shocks to its neighbors. So there it is, just written the same way. So now, so if we focus for a minute on the classic kind of default or cascade mechanism, it's the solvency loop, which was the S in the diagram that I showed of the different possible channels. And you get a very simple model, which just says that if you know the buffer, the delta buffer at the n-1st step, these 4 steps show you exactly how to update and obtain all the buffers, the delta buffers on the nth step. So you're going from n-1 to n. So those are those 3 steps that were in this picture. And it's expressed in terms of the impact on the buffers. And so I guess the punchline of the method is the bottom formula on this picture. So maybe don't read anything that I write, just look at the second formula that has an F with an N on it, and it's a subscript delta. That just represents the probability, this is the state of all the buffers in the system, okay, in shorthand, mathematical shorthand, is actually determined by the state of the default buffers at the start of the crisis. If I had I won't use the pointer. So the middle term in that formula says, notice it's F0 on delta. That's the initial situation of the buffers of the entire network. And then the last factor is this exponential, and it's truly the exponential function. And then there's this convolution on the data of the buffers at the n-1st step. So, and there's this R object which is doing a convolution. So really it's a very stylized, a very robust picture of what the mathematics of the crisis is. What the meaning of the F hat is, it's actually the characteristic functions in the sense of probability theory, and these mathematical operations are all perfectly legitimate. So that's the takeaway. I'll wrap up. Things about inhomogeneous random financial networks. The type of banks that you're including here allows for a kind of arbitrary diversity. We can have a very diverse set of channels and meaning for links. It's interesting to see how correlation arises. The bottom point is, I think it's important, especially here, to point out that the advantage of having a global model for the financial system that somehow is up and running in all different countries is then you need to be able to plug in your expertise. So as a Canadian, you know, we only have about 24 or 30 banks, so we know them very well. So you should be able to plug in expert knowledge into a global network to understand the system itself. So there's a reference to the Bank Panics paper, and unfortunately I don't have a paper available on my website on the inhomogeneous random financial networks, but it's a month away. Thanks very much.
Thank you very much, Tom. So I propose we go directly to the last so that we can have a few minutes at the end for the question. So now we have Igor Linkov on resilience.
Yeah, the bad news, I have 30 slides. Good news, no equations. So I will try to move fast. So I'm interested in systems that are affected by threats. So it's like this iceberg. You see very little about the system performance, but it's underlying issues that we need to deal with. So main ideas, we already discussed that economic systems are complex and adaptive systems, and system analysis is necessary. What I like to focus on is the issues of efficiency, resilience, smartness, and risk as a part of that. I would argue that they are very different and they have different culture and different methodological foundations. So we really need to think carefully about how to define them and how to use them. And I really like to talk about resilience as a feature of complex system that is really important in situation when you deal with system affected by threats. So we already see that. The way I like to see the world is that in real life we have interconnected social, cyber, communication, physical systems that needs to be modeled. And for me, the model is interconnected system of networks. But I'm only interested in this because I need to act on real world and I need to understand the impacts of that. So this idea of network resilience is actually what I practice. I have to say that I have not done economic networks, so view what I'm going to present as an example of what can be done if you implement this in real life. And I've done it for transportation network that I will be presenting, energy, cyber physical system, supply chain network, terrorism network, you name it. I think most of it I've done, but not economic network. So let me start with resilience. So this is from executive orders from previous administration and current administration. And definition of resilience is really in this corner. It's ability to adapt, recover, withstand, respond. I really like definition, but the problem with this definition, unfortunately, is that people don't use Oxford Dictionary. So what they've done, they combine what Oxford Dictionary defined as risk, which is situation involving with exposure to threats, and we already heard about systemic risk, with resilience, capacity to recover from the difficulties, right? So, and those are very different issues. As we just saw, risk is defined as probability of threat. Well, it's basically a triplet of threat, vulnerability, and consequences. We need to know what can happen, how it's affect the system, and what will be happening. The fundamental nature of risk assessment is figuring out how you harden a component of the system that results in system failure. That's what we just heard. While resilience is more temporal evolution of the system. Yes, we have a system going down if it's affected by threat, but then it recovers and adapts, and it has temporal pattern. And this is nature of resilience, is to figure out how this recovery and adaptation takes place. Of course, it should be connected in risk assessment. But it's very different culture. So the starting point of risk is fully functional system. We don't like to let it down, while starting point for resilience, the system already down, we like to recover it. And this fundamental difference is really propagates through the way how we see the systems, right? So this is a very simple system, bunch of connected wires, right? So what can be simpler than that? We translate energy through that. What happened is that in 2003, a simple software issue in one of these power stations, Akron, Ohio, resulted in 55 million people without electricity for multiple days. So if you think about that and try to do the systemic risks, how many wires you have to figure out what can go wrong with it? It's just impossible. Imagine our human bodies affected by gazillions of bacteria all over. Some of them live inside of us. And what can be situation that something can go wrong with this microbiome that we are surrounded? We have no ability to figure out how system is going to be impacted. But what we have immune system. We have ability through evolution to deal with that and recover, rather than have a library of all these connections of different bacteria and how they propagate. But in a sense, that's what we do through agent-based modeling or through some of the models that we presented. So the question is how the system can reconfigure itself and what would be equivalent of immune system. That's what really excites me. You would think that smartness and digitalization can really help. We're talking about smart infrastructure, smart grid, smart everything. The problem with smartness is that it can get matters worse. So Florida, again, talking about energy, a simplified economic system in a sense. They implemented smart grids and everything works fine, but 18 months ago they have unusual pattern of hurricanes, and what happened is that Florida was without electricity for the whole week, and I will come back to that. What happened is that smart systems are usually very difficult to recover unless they design specifically, right? So, but I will come back to that over the end of my presentation. So this is long introduction to the idea that you need to somehow measure systems' ability to recover in time and space. And of course, how you measure, you can either do it through metrics approaches or model approaches, right? And we were talking about network science, agent-based modeling, solve models. But of course, it's reasonable to start with metrics. We had our chief statistician, chief economist, and OECD is famous for developing metrics. And metrics-based approach is actually how we measure resilience now, and many efforts are focused on that. You try to structure all these metrics and combine them in an index. And of course, the problem with that is that not everything that counts can be counted, and not everything that can be counted counts. If you combine whatever you can measure, what you're missing system property. You're missing what is important for the system because you don't see it. It's like an iceberg. System is driven by what you don't see to a large extent. And indeed, when we try to validate all these indices papers in simplified case of whatever weather in US, southern US, you can see the different indices result in very dramatic difference output of the models. So what, I'm not going to talk about metrics-based approaches, but this is kind of, we see that. Remember this network of physical, cyber, social, cognitive. All these are different networks, and all of them have metrics associated with network. So if you impose this 4 networks with 4 stages of temporal evolution of resilience, and in each of these 16 cells you place corresponding metrics, at least you will be able to see that you describe the system in a way that you capture all relevant action, at least to the resilience of the system. And then you can really place weights in each of the cells that will represent whether you care about physical domain or social domain. If it's my agency, we build stuff, so physical is more important, but we cannot ignore others, right? So this is how we see that, and we can calculate resilience as weighted sum of all these metrics with weights represented values or mission space that is important to us. Now let's get to fun stuff, which is, well, I guess, yeah, network science, right? So we already heard about networks, so I will not get in methodological side of that. It will be very difficult given I'm the last. But let's look at an example, transportation network. It's very easy to represent it as the system of links and nodes. Links are intersections of roads. Nodes are intersection, roads are links. And people try to get from surrounding area to downtown or whatever they go to really do their work and all that. So how you measure efficiency of this? Well, we know that we have significant delays in commute, right? So less delays you have, more efficient the transportation network is. So we modeled this. We calibrated the model for 40 cities in the US. And you can see that it's calibrated quite nicely with only a couple of calibration parameters. But then what we start to do, we start to randomly generate disruptions. And I like to underscore it's randomly because I really don't like to say, well, this Pascal Avenue here is going to be disrupted. How in the world I will get to the airport? That's not interesting. We don't really know where disruption will happen. right? So if we randomly start to generate disruption with different rates, you can see that Boston and Los Angeles reacts differently. And this is because they have different networks. So 5% of disruption will result in like 14 hours delays in Boston, while in Los Angeles only 4 hours. And if you do it for all cities in all 40 cities, you can then cluster them based on efficiency and resiliency. You can see that some cities like San Francisco, Washington, we look only in the US, though we now have Milan and we do more complicated study there. But you can see non-efficient, non-resilient cities. But then you can see what is interesting, like Los Angeles is equally bad with transport and delays like LA. But you can see that Los Angeles is among the most resilient cities in the US, while San Francisco is the worst. You can also see that you have cities that are efficient but not resilient, like Florida. So why? You can intuitively, if you know a little bit about the US, you can intuitively understand what's happening. In Florida, you have a couple of highways along the coast. And if something happened in one of them, it's pretty much system stops. Because there are no way to get around. You have to go to another highway, and it takes a lot of time and efforts. But if everything works, it's very efficient. You have big highway, a lot of space. It really works. What happened in Los Angeles, you have a grid of network of roads, and if something happened, you always find a little road to go around it. While in San Francisco, you will have difficulties doing that because you have several bridges and several highways. You cannot escape. So why it's important? Now getting back to economics, and this is one idea that I believe is important. We cannot revolutionize economic modeling as a field, but we can really show that applying economic models in the context of system properties like resilience versus risk may be different. So we use regional economic modeling, and we try to say, okay, what happened in Atlanta if you have bad winter, right? You can see a huge disruption, and it recovers eventually, but you have a job lost and hundred millions of GDP lost. What happened if you, what are the costs of resilience versus efficiency? Apparently, they have very different costs. If you measure efficiency, you have very limited loss in GDP. But if you have the same delays due to resilience, you have much significant worse. Why? Because you kind of can prepare for normal delays, but if you have major issue, you cannot really build it in the way you do business. So these economic models clearly show that. And why it's important? It's important because resilience and efficiency have to be managed differently. I already said that the easiest way to improve efficiency is to add lanes in the highways, while for resilience, you need to build new roads, you need to think about public transportation, you need to think about how people will accomplish their tasks if disruption happens. A little bit about smartness. So what happened in smart system, we try to let computers to drive everything, right? And what happened is if you just do that, and if the top node of the system is affected, then the whole system collapses. And unless you recover that top nodes, you cannot really operate. And that's exactly what happened in Florida. They had to recover the whole network before they start to deliver electricity. So you need to be smart and resilient at the same time. And we did similar work for intelligent transportation system that shows that this smartness not necessarily correlate with resilience. And in most of the places, anti-correlates. Again, sustainability and resilience, again, is different concepts. I already spoke about digitalization. And very interesting, again, thinking about economics and all that, all this economic system, financial, transportation, engineering are part of these value chains, right? So in a sense, the question is how you sustain resilience in the whole value chain. And that's, again, maybe a new way of thinking about how you bring all components of the system together. And again, why it's important, because we have, back to risk for a moment, buying down risk is getting to be more expensive when you go to smaller and smaller risk. You can buy down a lot of risk with reasonable cost, but if you chase low probability, high consequences risk, you're spending a lot of money. So that's it. We published a lot. This book, Science and Practice of Resilience, probably everything I know about resilience. So it's out last month. We'll be glad to share some of that. Thank you.
Thank you very much. So I think we can thank all the speakers. And we have time left for questions. So if there are any questions for any of these, yes?
So I have a question and a comment. Question for the first paper. I thought it was fascinating what you're doing with the textual analysis. But it wasn't clear to me what is the benchmark. So I would expect legislation to get more complicated after the huge mess of the financial crisis. But did it get way too much more complicated than it should? I mean, I don't know if you can measure that somewhere, or maybe that's where you're trying to go with the reasons. And then a comment on Gerd. It wasn't clear if you're using the Belgian data set to get some of the links that you're missing in your own data set, or you're using that as a sort of a training sample. Because I would be, we could talk about it, but I would be glad to share our data. You can not share the data, but you can access the data through a network, and you can test whether your algorithm is doing a good job because you have, you have the whole links. So, thank you.
Okay, thank you for the question. That you kind of hit the nail on the head, because the question that almost motivated the research in the start was, how complex does prudential regulation sometimes need to be to achieve its objectives, given the properties of the system, the complex system you're trying to regulate? And as that is a huge question, and when we looked at the literature, we didn't see much even to begin with on measuring some interesting things. We started by trying to tackle the positive side of it, to get some measures to it. But to try to move towards answering that question, with what we've got, we can take it to policymakers and we can say, these are the outliers, these are the distributions we see, do these confirm or challenge your expectations? We can also think maybe about benchmarking what we see in the UK against other jurisdictions. So in many cases, different jurisdictions are implementing Basel standards. So there's one common set of standards, they're doing it in different ways. A challenge is that they have different legal systems, so the ways that they will express those things will be different, but at least in principle, that's one way to get a handle on it.
Thank you for your comment. We do not use that Dun & Bradstreet data set really as a training set, as in machine learning. We want to use it as a way to assess the quality of the data, the imputation method, and then try to, there are various, let's say, buttons to turn on in this approach, and we'll try to figure out which one works best. But I'll be very pleased to discuss with you possibilities to get some of your data or some of your insights to improve our own method. Thank you.
Okay. Thank you, Matthews. And then William.
So I have two questions, one for the first speaker and one for the last. So for the first speaker, that paper that you mentioned by Lee et al., if I remember by listening Andrew Lowe's presentation on that, they focus a lot on, I think, what they call the core of the code, right? So the strongly connected component, and borrowing from software engineering, it's better if it's a smaller core because that adds, it can have more modularity, and also you can change it without having to revise everything. So do you do that kind of analysis as well? And does it come out of some of the statistics that you mentioned for that network? And if you do, what can you tell about it? And then for the last speaker, is in that picture you showed of the resilience and efficiency for the different features, I was just wondering if you treat each of the networks as data points, and then do a PCA on that, on the several properties of the networks. What would come out of that? I mean, what is driving that relationship that you have? So that's...
Thanks. So on the network side of it, yes, I remember that core versus peripheral type analysis. It's really interesting. We have so far invested heavily in building the data set and are now seeking the best ways or the most insightful ways to kind of go beyond degree and page rank to explore this structure. So that's something which is on the list. We would be really interested in other ideas, basically to explore redundancy maybe in that network and what the effects of policy interventions might be. So I will take that on board as an idea to follow up on.
No, I have time. So answering your question, so this is again, everything can be derived from this. In efficient system, you have usually centralized control and optimal configuration, right? So you can quickly reallocate resources and quickly reroute traffic in my case. But if something happened to this centralized algorithm, if you hit a breach, then it collapses, right? While in resilient network, you have multiple ways to do the same thing. So you may be hitting more and more, but it will still be performing. So that's kind of the difference.
So now William?
Very simple question on the Dutch trading firms. You used the term commodity repeatedly. Do commodities include services? Oh, that's good to know, given how important.
No, basically, commodity is a word that's used in national accounting, so it's both, let's say, goods and services.
Thank you. I have some questions for Professor Hurt specifically. First of all, thank you. It's a very interesting, very, very dense paper and presentation. Just for me to clarify, sort of like, what did you say? We combine an Eisenberg-Noé model with sort of like a fire sale framework where banks sort of like need to, if they sort of like, if their assets decrease in value, if they have insufficient liquidity, they need to sell assets and incur losses through that. And if my interpretation is correct, sort of like, could you maybe contrast your model to the model by Content Shanning, in case you're familiar with that? Specifically, I mean, I know like you include sort of the interbank contagion aspect, which is a huge difference. Like I'm more interested in sort of because they sort of include like two types of buffers, sort of like one buffer below when they actually start fire selling, and the buffer to which they actually sort of they sort of like the leverage target is slightly above that threshold. And they say like, did you need to introduce that in order to avoid having this sort of like spirals where everything goes to zero in the end, because everybody just keeps selling and the price just keeps getting depressed and everything, there's like less and less equity in the system and just like everybody keeps depressing the prices. And maybe also, because I might have missed it, like maybe you could say a little bit about how you calibrate the demand curves or like the demand, the price reaction for fire sold assets.
Yes, so three questions. The Content Shanning paper is all connected with the fire sale channel, which was the selling of assets into a falling market, and indeed they have a very flexible, I think, arrangement. It does involve overshooting, so they sell more. So if their capital buffer has gone below a threshold, they sell beyond what is needed to go above the threshold, so they overshoot, and that creates a little bit more systemic amplification. Yeah, the fire sale component of, as I proposed in the paper that's published, does involve a demand curve, which I just go with what was done by the Cifuentes et al. Paper. It's just an exponential with a depth of market parameter, which is heuristic only. So I simply, so in fact, all issues of calibration, I'm looking for partners in various jurisdictions to implement and realize these models, and that's a big challenge. I'm just going very far forward, trying to get enthusiasm for people to explore models of this kind of style. The two types of buffer, I'm not quite sure what the question was, but they're definitely an interesting interaction between the effect of funding illiquidity. It's known that banks that have reduction in their funding are definitely going to be less resilient to insolvency. So they're more vulnerable to. Oh, so it's gone off again. So definitely there's a linkage which was part of the model that we want to explore, which is the interaction between the two buffers. So I'm not saying that will come out. So not all of these features are captured in my base level models, but the intent in the long run is to include all these effects. The third question, I think I answered it about the demand curve. It's just simply a one parameter demand curve that we have a heuristic for. My rule of thumb is basically something like if they sell 20% of their assets, the price drops by 20% or something like that. I can't remember how I explain it, but it's a heuristic.
Second question, like the overshooting, as you call it, like it's including the content sharding model in order to sort of avoid this dynamic which you can get quite easily, that sort of like a bank faces a loss and it tries to sell assets in order to get back to its leverage target, and then sort of like through this fire sale it incurs a loss, takes it further away from the leverage target, and they very quickly end up at a spiral where sort of like all banks sell all their assets and the price is zero, and there's sort of like this is a mechanic that sort of like prevents that. So does your model like sort of like prevent? Do you have these like sort of like convergence to zero in your model or not, or?
I don't think it would converge. It's not going to converge to zero, but let's just see what concrete to say about it. I'm not sure how to answer your question, but one thing that I observe, a lot of the Kohn-Shanning paper is connected with multi-dimensional asset universe. So many correlated, the class of assets that banks are holding are correlated but different. And so there's this question of how they tend to liquidate assets, what's the liquidation order, a lot of questions like this. I think there's something to be said for assuming that all the assets are one and the same asset. That's kind of the most pessimistic view of how fire sales would evolve in an economy. The worst case is that everything becomes so correlated that, and so in some sense that makes the model much easier. So the model that I would first explore, rather than go to the multi-asset type model, is just a single asset model. And in exactly the same way, I think it's easier to think of bank panics than bank runs. Bank runs would be targeting weak banks, whereas a bank panic is somehow a panic about the whole system. A bank panic is sort of the most pessimistic view, and the whole system is vulnerable to a run that could be a lot worse. And in some sense, in a network where there's very incomplete information, I think the funding, the wholesale markets will tend to not be discerning. They won't be able to necessarily identify the weak sectors of the banking economy. So they're likely to actually get quite indiscriminate in the way they would withdraw their funding.
Okay. Thank you, Tom. I interrupt you because we have to close the session now. But fortunately, the organizer have planned us a networking session in the Marshall Rooms, which is at the Chateau. So I would like to thank again all the speakers, and we all meet you so at the Chateau in the Marshall Rooms for a cocktail. And thank you also for the organizer and the audience.
Sitting there already. Pardon? No, I'm actually going. I'm going Wednesday morning. We're going to sail around from one side of Sicily to the other. did the other way 4 years ago, heading east, now we're heading west. Being bringing
Is it as fragile?
Yeah, heading for
What we really want to do, you mentioned the multiplex network. Those layers you're working out, those, I mean, there must be potential to trace these things through.
Well, you know, Southampton.
That's definitely one of the next steps.
And I'd love to do Scotland. Just something different. I just did that.
So one of the policy work in the bank asks that normative question: how complex is it will be? And at the same time, what's happening outside is people are asking, have we gone too far since the crisis? Is it efficient or is it proportionate? So this is just to give another handle to give some structure to conversations about it.
I've got a big
Is there any difference between negative and positive one? One saying you mustn't do this and you must do worse.
We haven't sorted it out. Yeah, things that are sort of positive direction versus
I work on NAEC.
Thank you very much. I don't have a card, but I can.
Two words.
Thank you very much.
Sailing single-handed because people
The Roman Empire, British Empire,
From the outside perspective, it could work here.
Hello, introduce myself. London Master at Policymaking. Some stuff about banking regulation. Can I give you my card?
Yes,
maybe we can chat back in London.
Thank you very much.
Do you have a card?
I'm afraid I don't, but I can send you an email.
Would you? That'd be great. Thank you. Thank you very much. Great presentation. Good thing about the guidance and all that.
Yes, that's very interesting. So, yeah, this network ideas. I really like to give example of financial networks so we can apply our definition of resilience and do something cool with it.
Because we were thinking, like in our network, if you deleted bits of regulation, what would happen?
Exactly, yeah.
Which is this.
So all we need to do is to really work with you and introduce temporal patterns in that. If you tell me how much time you need to do in complying with all this regulation, you can get an expert, right? Because, well, this will take like 1 day, this will take 5 days, relatively, right? Or this is high, medium, low. If you do that, we can really plug it in our model and you will be able to see recovery of the system, right? So.
I will send you my details and we will think about that.
Excellent, yeah.
Thank you.
Do you have your card by any chance?
I have no card,
Okay,
I'm afraid.
maybe you
I
can
can write your, yeah.
But we, you know, I think I was way ahead of my time because I was proposing natural language processing actually just to diagnose speech degradation in people with post-traumatic stress disorder 10 years ago.
Okay.
When we were sending people in Afghanistan and all that, it didn't go too far. It was too novel.
But now it's just so much.
Now it's, yeah. But I moved to others.
You were too fast.
Yeah.
Thank you very much.
Okay.
Nice to meet
It's
you.
very nice meeting you.
Have you worked on climate risk in your project?
Yeah, that's actually was one of the first paper that we had is in Journal of Nature Climate Change.
Thank you very much for the organisation.
One of the workshops organized.
Are you here tomorrow?
No, we fly back.
But we didn't.
Good luck with everything tomorrow. Thank you.
And you don't even have time to have a drink this time?
Network science. Because what happened
Such a travel budget. Thank you.
Okay. Climate related work. So I thought.